very respected and eminent speakers of this evening, Shardul Shah from Mumbai, Shajan from Thrissur, Secretary of SIRC, Panaraj from Bellary, senior members, friends, very good evening to all of you. On behalf of SIRC, I welcome both the speakers and also welcome all the members who are attending this program. Yes, you all are aware, SIRC has always been in the forefront to bring it to its members numerous learning activities on various subjects, and today we have great and contemporary subjects of professional interest for dissemination of knowledge, taxation of HUF, audit of cooperative banks and opportunities, and taxation of cooperative societies. Nowadays, these are the topics are getting importance among the members. I also foresee the huge scope of professional opportunities for chartered accountants in respect of cooperative banks and days ahead. Today, the advent of new areas of professional opportunities and the technology have made us to realize that a challenging task is ahead, and at the same time, a glorious future is waiting for our profession. I am sure the members who are attending will get a feast of knowledge out of this evening program. With this brief note, I request Secretary of SIRC, Panaraj, to introduce the speaker, first technical speaker. Please unmute, sir.
Thank you, Chairman, and also good evening to all of you. I take the pleasure of introducing the first speaker for the day, who is speaking on taxation of HUF. CA Dr. Shardul Dilip has a long academic career. He has done his post-graduation and also chartered accountancy from Mumbai, and his doctorate topic is royalties and FTS. He has been practicing in Mumbai, and his association with the WIRC is that he was regional council member and secretary, also chairman of WIRC during 1999-2000. Very happy to know about it, sir. He gives lectures to students also, and he is associated with various trade bodies, and he is a faculty at various bodies and actively associated with Bombay Chartered Accountants Association and Chamber of Tax Consultants, and is life member of AIFTP, GST Practitioners Association, and also member of Finance and Committee of Darware Club House, and life member of Bombay Management Association. He has authored many books and articles like FAQ on Charitable Trust published by JCA Foundation, handbook on PMLA, reference on FEMA, WIRC of ICAI Union Budget Publication, and an article on PMLA for ICAI in 2018. Has presented papers at various forums, international conference titled Issues and Challenges in Startups, also international conference in Dubai and also in India on recent developments in international taxation, national conference titled Reforms in Banking Sector, international conference titled Regularly Contributing to BCAS and WIRC of the ICAI panel. With this illustrious career, we are very happy to have you today, sir. Thank you for accepting our invitation, and over to you.
Over to you, sir. Please, you can proceed.
Respected Chairman of SIRC of ICAI, Shri Jalapati ji, respected Secretary of SIRC, Shri Panaraj ji. So thank you so much for the introduction. I think he has said much more than I deserve. Respected all the seniors of SIRC Council, all the people who have coordinated this program, and all my dear friends, a very good evening to all of you. At the outset, let me thank the chairman of SIRC for giving me this opportunity of sharing my views on this particular topic. And whatever little bit of knowledge I would be having, I'll be sharing on the topic. Time permitting, also I would be covering up incidental topics of, for example, family arrangement, and if at all, maybe of trust, but I request the chairman of SIRC to probably keep a separate dedicated program just on the taxation of trust, so that because in at least in our area, that is in the western region, there is a lot of inclination to learn about taxation of not only trust. When I say trust, it is private trust also and charitable trust also. And there is a huge bit of tax planning opportunities as far as private trusts are concerned. And this is going to be a different topic altogether. Time permitting, I may just touch upon some of the intricate issues as far as trusts are concerned, because you would have, I'm sure all of you would have known by now that the budget 2021 has brought about certain very important amendments, and also the amendments also require re-registrations of the trust. So this is very, very crucial, and you are aware that the time frame for those re-registration is also very stringent, and we are talking about all charitable trusts being required to be re-registered. So this is a Herculean task. Also, you are aware of the changes which are proposed as far as FCRA is concerned, because FCRA itself is very, very hotly and very, very important concept as far as trust is concerned, because all foreign contributions are governed by FCRA, and certain important requirements, for example, opening a dedicated bank account in State Bank of India, New Delhi, even is becoming difficult. Although most of the trusts are getting the same, but it is a task by itself. Also, you are aware that last year some of the changes with regards to bringing down the administrative expense from 50% to 20%, which again is become a big issue as far as for trust which are receiving FCRA. So again, FCRA by concept would require a lot of focus, but in times to come, I think the kind of the role the trusts are playing in today's time, especially during the COVID times, I think the trusts are doing a very, very good job. Lot of private trust, lot of public trust are doing a lot of philanthropic work, and we must complement all their efforts. And that's why these certain changes in the regulations is something which we all should not only learn, but we also should bring much more clarity to all our clients. So with these opening remarks, friends, I would like to share my slides. Can you see my slides, friends?
Yes, sir.
Yes, sir. Visible.
Yes, sir. Yes,
Yeah.
sir. Visible, sir.
Great. So the topic allotted to me, friends, today is on taxation of HUF per se. I'm sure all of you all are aware what HUF is. Before I get into the slide proper, if there are, friends, any questions at any point of time, I'm sure someone is keeping note of the same. But if not, I think I request the organizers, probably maybe at the end of the session, we can have 5 or 10 minutes, for any of the attendees to put up any questions in the chat box, and the same can be collated, probably debated and deliberated at the end of the session. So please do let me know when my time is coming nearer to end, so that we can allow if there are any questions, or if there are any possibilities of having clarifications from our members are concerned.
Better to have at the end, sir.
After his session, sir, Panaraj sir, after his session or after all the 3 sessions?
After this session, no, can you stay for the third session?
How sir is feeling, sir? How would
Sir, after this session, because I have another meeting lined up.
Okay, then after this session, after the
Yes,
session, we can have 10-15 minutes. Something we will discuss, and then we
Yes,
will
sir.
start the next session. Yes, sir.
Yes, sir.
Then you consolidate all the
Yes,
questions.
I'll compile, sir. Compile. No problem.
Okay, thank you, sir. Thank you.
Can we start, friends?
Yes, sir. Yes, sir. You can start, sir.
Can you see my presentation?
Yes, sir.
Yes,
We
sir.
can see. Yeah.
Yes, sir. We can.
Yeah, great.
You can start, sir. It's visible.
Next slide, sir. Yeah, visible.
So friends, as you all are aware, the topic for the day is taxation of HUF. So obviously, it is very essential for all of us to first and foremost understand what is Hindu. Who is a Hindu? In this term, all are included are those who are Hindu by religion. Section 2 of the Hindu Succession Act 1956 elaborately declares that it applies to any person who is a Hindu by religion in any of the forms or developments. And it includes friends, a Vaishnav, a Lingayat, or a follower of Brahmo, a Pratna of Arya Samaj, a Buddhist, Jain, or a Sikh. So please remember, friends, the judgments over a period of time have expanded this concept of Hindu now to also include Jains, Buddhists, and also people who are Sikhs. So what we are trying to understand is there are decisions. For example, in Champa Kumari Singh, way earlier in 1972, that is 18 ITR 722, the Supreme Court has held that HUF also includes Jain HUF. So what we are seeing is just because it's a pure Hindu, slowly and steadily, this particular concept of Hindu has also been expanded to cover a few more other religions. Obviously, you would like to know is how does a HUF come into being? Please remember, friends, a Hindu male with his wife and children automatically constitutes an HUF. Please remember, friends, that HUF is the creature of Hindu law. It cannot be created by acts or by any party insofar as, for example, by adoption or marriage. A stranger may be affiliated as a member thereof, but he cannot create an HUF. HUF family is which is a normal condition of a Hindu society and is ordinarily a joint, not only in estate, but the person is together in family in food and worship. Joint family being the result of a birth, possession of joint property is only an adjunct of the joint family and it is not necessary for its constitution. So please remember, friends, just because we are talking about people who live together or some kind of adoption, that cannot constitute a HUF. What a HUF requires is a family, Hindu undivided family. So that is the starting point. HUF is a family which consists of all the persons which are lineally descended from a common ancestor and also the wives and daughters of the male descendants. Typically, friends, we are talking about 4 generations which are generally covered in an HUF. So a person which is the head of the family is called a Karta, consists of a Karta. So Karta is typically the person who is the eldest person of the family or who is the head of the family. Please remember, friends, in any HUF there can be only one Karta. There cannot be multiple head of families or there cannot be people who are having multiple areas of power. There is only one person who is the eldest person in the family who is called the Karta, and all other family members are called co-partners. Please remember, friends, this concept of Karta is very, very important. This Karta or the person who is the head of the family or the eldest person manages the day-to-day affairs of the HUF. He is the person who is like the person who you call the CEO or the managing director. He is the main person of the entire affairs of the family. The children are co-partners of their father's HUF. Once a daughter gets married, she becomes the member of her husband's HUF while continuing to be a co-partner of her father's HUF. Please remember, friends, just because a girl gets married, that does not mean that she is excluded from her father's HUF. She continues to be a co-partner. She continues to be a member of her father's HUF, as well as she becomes a member of her husband's HUF as well. Even Jain, Buddhist, Sikh families, as we already discussed earlier, can also have their respective HUF. So who is the Karta? Again, we are going a bit more into detail. This is the person who manages the affairs of the family. He is known as Karta. He is the senior most male member of the family, is known as Karta. However, a junior male member can also act as Karta with the consent of the other members. Please remember, friends, it is not necessary that just because there is a senior most member, he becomes the Karta. Yes, there is a possibility with the consent of other members, the junior member can also become a Karta. And that is possible, and that is expressly provided in the Supreme Court judgment of Narendra Kumar Modi versus Narendra Kumar J. Modi versus Seth Govindram Sugar Mills in 57 ITR 510, the Supreme Court had made it very, very clear that yes, with the consent of other members of the family, a junior member can also become a karta. This typically happens, friends, at a time when the elder person is not well, he's incapacitated, sometimes he's ill, he's not able to spend more time, effort of the family property, and hence a junior member volunteers and he comes up with the consent of all other members to also become the person who manages the day-to-day affairs of the family, and hence he becomes the karta. Nothing wrong, friends. However, in view of the present social mores and needs of the modern progressive society, this decision may be reviewed. Besides, the same person can be taxed both. Please remember, friends, that as far as taxation is concerned, he can be taxed both as the individual and also separately as a karta of HUF. Because as far as his own income is concerned, that continues to become taxable at his own individual level. As far as the income of the HUF is concerned, HUF is typically the family property, the ancestral property. It is a property which has come down from generations to generations, and hence it has to be taxed separately. That remains the property of the HUF. Individual and HUF are definitely two different units of taxation and two different assessees. Very, very clearly defined, and it is expressly provided in Supreme Court in the case of CIT versus Rameshwara Samarlal's case of 82 ITR 628. So what we understand, friends, now is both these individuals and karta are both separate and remains to be separate, and both cannot be taxed together. The income of the individual remains to be of the individual, and income of the HUF remains to be taxed separately as HUF. What about the property, friends? The most importantly, you have to remember, we are talking about the property which is generally coming down from generations to generations. And this property which comes down generations to generations is not owned by a particular person. It is of joint family in nature. So for example, following types of properties are generally accepted as joint family property. For example, ancestral property, property which is allotted on partition. So there might be some other earlier HUF which is created by forefathers, and that on their earlier partition, the property which is devolved upon a subsequent HUF is something also how the property is generated in partition, and that property comes into another HUF, property which is acquired with the help of the joint family property. So there is a property which is owned by the family members, and by funds which is generated from those respective income can also be constituted as the family property or the HUF property by way of the income of the original property. So separate property of a co-parcener, so blended with or thrown into the common family hodgepodge, is also becoming the property of the HUF. Please remember, friends, an individual or any other family member can also decide at some point of time that he puts that same property or his own individual property back into the HUF, or but please remember, once he puts it into the HUF, there is no manner he can remove the property. That property will then become the property of the family, and he cannot, even at later point of time, by way of will or any other manner, also he cannot have any power to then have discretion to decide upon it individually. He will have to involve other people who are members of the family. He will have to consider that property to be a part of the larger family, and asset will then become part of the joint family. Provisions of Section 64(2) of the Income Tax Act, which have superseded the principles of the Hindu law in case where a co-parcener impresses upon that his property is with the character of the joint family in nature. A female member, friends, please remember, cannot blend her separate property with the joint family property, but she can make a gift to the HUF. So there is absolutely no problem as far as gifting of any individual property, whether by is a male or a female, into the HUF, but she will not be able to blend it. So gifting it into the HUF again is absolutely no problem, and this is expressly provided in the decision of Pushpa Devi versus CIT 109 ITR 730. A female member can also bequeath her property to the HUF, which was expressly provided in CIT versus GD Mukin 118 ITR 930 by Punjab and Haryana High Court. What about a HUF creating other smaller HUF, or by way of creating smaller or new branches? An HUF can be comprised of a large number of branch families. So friends, please remember, it's like a tree. A tree grows, as it grows older, it has more branches, and from those branches again you can have more branches. That's how concept of HUF is. An HUF can be composed of large number of branch families, each of the branch itself being an HUF, and also the sub branches of many more branches. So this is expressly provided in CIT versus MM Khanna 49 ITR 232, that a particular HUF, it is not standalone, but an HUF can have multiple branches, and those branches can also have multiple branches, and that particular tree grows and grows and becomes bigger and bigger and bigger. Please remember friends, under section 231 of the Income Tax Act, HUF is considered as a person, and therefore it is treated as a separate entity for the purposes of tax assessment. And this is where we understand the concept of HUF is there. HUF is present primarily because of its separately being defined in the section of the Income Tax Act, and Income Tax Act actually gives sanctity to the concept of HUF. Often families that own ancestral properties and businesses often a separate PAN account number, that is permanent account number, the name of the HUF. Because this being a separate entity by itself, then you can probably make its respective investments, and obviously once it has a separate PAN account number, it is considered as a separate legal entity. It will be having all the investments as an individual. The taxation of an HUF is like an individual, and all the tax benefits, for example of PPF and other deductions also which are available to an individual, are also available by way of creating a separate HUF. Please remember friends, HUF cannot be created by way of a contract. It is created automatically in a Hindu family. Funds which are invested by HUF, the income of the HUF as it arises out of the investment of its own funds, is also taxed separately. Any other personal investments are not to be included in the HUF, and the personal investments will be considered separately. For example, when a HUF also is constituted for a way of partnership, remuneration which is paid by the HUF to the Karta also, if it is again reasonable, it is deductible in case of the partnership, and yes, that particular remuneration will be taxed individually in the hands of that person who received that remuneration. The rate of tax, as I told you, is already discussed, is as applicable to individuals, and also the alternative minimum tax as 18 point the AMT is also applicable to the HUF. As far as timelines are concerned, I'm sure friends are aware, as the timelines of income tax apply to individuals, the same are also applicable for HUF. That is typically the July, and in case there is an audit, then September is the due date for filing the various returns. So these are the the kind of the background under which you have to remember that more or less most of the principles or the taxation concept are available as far as HUF is concerned, is similar to that of individual. So what are the essentials? Please remember friends, before you get into forming an HUF, you have to remember what is the essential of an HUF. Only one partner or member cannot form an HUF family. HUF family is a group of people which are related by blood or by marriage. So please remember friends, one person cannot create an HUF. So a single person, male or female, not constitute a family. Property which is held, but subsequently property which is held by a single co-parsoner does not lose its character of the joint family property solely for the reason that there is no other male member or no other female member at that particular point of time. Please remember, friends, at any point of time, if a property has been created which was in the name of the family, it always remains a joint family property. And just because there are no other persons which are present at that point of time, it loses to be a family property. It will always continue to be a joint family property. Once the co-parsoner marries, please remember HUF comes into existence as he, along with his wife, constitute. So as once a person gets married, he has a family, and along with his children, then it becomes a family. So husband and wife constitute a separate Hindu family, as it was expressly provided in case of M. Kumar versus CIT 121 ITR 347 Allahabad. So this is very, very important, friends, that once so person remains to be in a family or in a HUF. Once he marries, then he has the right to create his own separate HUF. Joint family continues even in the hands of females, even after the death of the sole male member. So this is very, very important, friends. Take an illustration where there was a joint property and a male member dies, but the females, although they are married, even if they are married, that continues to be, that female has the right because it was earlier owned by the family, and hence she has the right over the joint family property as well. Even after the death of the sole male member, so long as the original property of the joint family remains in the hands of the widows of the members of the family, the same is not divided among them, the joint Hindu family continues to exist. Please remember, friends, the widows of the male members also continue to have the rights over the family property. This was expressly provided in Virappa Chettiar in the case of 76 ITR 467, that women of the joint Hindu family, even if the widows, they have the rights, and as long as they are not divided, then they have the rights over the joint family property. Male members. An HUF need not consist of two male members. Even one male member is enough. So even if there is one male member in the family, it's enough as far as HUF is concerned. I believe that there must be at least two male members to form an HUF as a taxable entity is actually not required. And this was expressly provided in the case of Gauli, Budhana versus CIT 60 ITR 347, C. Krishna Prasad versus CIT 97 ITR 493, and Surjit Lal Habda versus CIT 101 ITR 776. So this is very, very important, friends, that it is not a requirement that two members have to be present to create a separate taxable HUF. There is always no confusion about a family which consists of daughters. A father and his unmarried daughters can also create an HUF. This was provided in Harshvardhan Mangaldas case 194 ITR 136 by Gujarat High Court. Other friends, please remember, on partition of an HUF, a family consisting of co-parsoners and female members is to be assessed in the status of HUF. This is also very, very important for us to remember that in case as and when partition also happens, then the co-parsoners and female members have also to be accessed as the status of HUF. It is many of times, friends, argue that existence of nucleus or joint family property is necessary to recognize the claim of HUF status in respect of any property or income of HUF. Now, friends, it is clear since HUF is the creature of Hindu law, it can exist even without any ancestral or joint family property. So it is not necessary that at the time of starting of HUF it has to be ancestral property that can be generated or that can come out or arise maybe at later point of time as well. So at the starting point, it is not necessary that ancestral property is there. Although a lot of times, yes, ancestral property is there, but it is not always required. This is done, friends. We are talking about some types of tax planning that HUF is done so that the income earned from the assets and businesses which are owned by HUF are assessed separately, which also brings down the family's tax liability. So a lot of times what happens, there are people, HUF is in the highest brackets and the co-partners of people who are members of the HUF are actually at a lower rate of tax, and hence sometimes you may have to do some planning. And also people who are in the highest brackets of taxes would like to have a separate entity which is an HUF, and hence HUF is taxed separately. And you have to remember that the rates of taxation or the slab rates and which are applicable to individuals are the same which are applicable to the assessee. So probably HUF income, since it is separately taxed, the assets are also considered separately. It's absolutely a separate entity by itself. There is some bit of tax planning possible. What about residential status? Please remember, friends, Section 6(2) of the Income Tax Act suggests that a Hindu undivided family or the firm or any other association of persons is said to be resident in India in any of the previous year in every case except where during that particular year the control and management of the HUF is situated exclusively or wholly outside India. So even if a small bit of control or management of the HUF remains to be in India, then it under Section 6(2) an HUF remains to be a resident in India. Further, Section 6(4) suggests that every other person is said to be resident in India in any previous year in every case except where during the year control and management of the affairs is situated wholly outside India. Meaning thereby, friends, it clearly spells out that as long as the control and management of the HUF remains in India, even partially, then it is considered to be resident in India. As far as again tax planning is concerned, we have already discussed that by increasing the number of assessable units, because HUF is a separate assessable unit, and the device of partition of HUF is also possible. So when you have branches and multiple branches, one entity or one particular branch can be then converted into a separate HUF. By creation of separate taxable units of HUF who will in favor of the HUF or give to the HUF. So please remember, friends, the property which goes into an HUF can be given or can be vested upon by way of gifts or by way of will or from that individual property. HUF property can also be contributed by way of family settlement or through a family arrangement. By payment of remuneration to the Karta and other members of the HUF is also possible. By use of loan from the HUF to the members of the HUF. So when HUF has sufficient funds, it is possible for you to provide some kind of loans from the HUF to the individual members of the HUF as well. To gifts by the HUF to its members, specifically to the female members. A HUF can give gifts to the other members of the family as well. As far as high net worth individuals are concerned, please remember, in case where the members of the HUF have got high individual incomes, in such cases, it is not advisable to break or partition the HUF because they are already under the highest bracket. If you are going to contribute or if you are going to give them more money, obviously they are going to be taxed at the highest rate in any case. HUF should be allowed to continue as a separate taxable unit. So as far as HNIs are concerned, friends, it doesn't make sense to have, it doesn't make sense to partition the HUF or even break it, but it may be advisable to continue the HUF as long as the HUF has a separate business and maximum amount of benefit can be taken as far as the separate assessable unit is concerned. Hence, sometimes in the past this was permitted, but today it is not possible, friends. Partial partition of HUF was also attractive for reducing the tax liability. Partial partition was recognized under the Hindu law. However, friends, partial partition of the HUS has now been de-recognized by section 171(9), subsection 9 of the Indian Income Tax Act 1961, according to which now, friends, any partial partition effected after 31st of December 1978 will not be recognized. So now it is only concept of you either continue with HUF or you do a full partition of the HUF. There is no possibility for which you could do a partition which is half-hearted, or you can do a partial partition. Not possible. What about partition, friends? Please remember, friends, section 171 of the Income Tax Act 1961 deals with the assessment of an HUF after partition. So before partition, friends, as I discussed with you, HUF remains to be taxed as a separate assessable unit, and it is considered the rates of tax, the applicability of the provisions of the Act as applicable to an individual applied to HUF. However, the concept of partition is also there. Partition means breaking the HUF, and section 171 talks about assessment after the partition. So clause A of the explanation to section 171 defines partition of HUF, where property admits of a physical division, then a physical division of the property thereof. So we are talking about physical division of the property. For example, there is a property which has 5,000 square feet and probably can be divided. But where the property does not admit of a physical division, then subdivisions of the property as admit of will be deemed to be a partition. You will have to find out a way in which the property can be bifurcated into all the members of the family. Partition need not be by metes and bounds, but separate enjoyment can otherwise be secured, and such division is effective so as to bind the members. Please remember, friends, that it need not be by metes and bounds, but as long as a separate enjoyment can be provided, and by way of which all the members of the HUF can have the respective shares. That is the objective of the partition of the HUF. Please remember, friends, the members of the HUF can live separately, and such an act would not automatically amount to partition of HUF. So this concept of partition of HUF has to be expressed, and it has to be something which all the members of the HUF should mutually decide upon, and has to, in case of a property, it has to be expressly by way of document such that the partition can be expressed. But just because the members of the family are living separately, that does not mean necessarily that the HUF has been partitioned. This is expressly provided in the case of Shri Narayan Chaudhary versus CWT 108 ITR 104, that just because you live separately, it does not mean that there is an automatic partition of the HUF. A finding of the partition by the assessing officer under section 171 of the Income Tax Act 1961 is necessary. So whenever there is a partition, there has to be a finding. So assessing officer passes the necessary orders in case of an assessment, and that particular assessment becomes necessary in terms of expressly being provided under section 171 that the partition has come into effect. Motive or need for partition cannot be questioned by the income tax department. This is very important, friends. So just because there is a particular intention which has been created, or there is some mutual disharmony, or there is, when children become old and they want to have their own ways, or the elders in the family also decide that yes, I want to now give sufficient funds to my children, and they should separately decide upon their own course of actions. So all this is something which the department or the income tax department cannot go into, or they cannot probably discuss or deliberate what could be the need for the partition. So it is something which the family has to decide, and the partition of the HUF is something which is very, very internal in nature, and is something which has to be discussed and deliberated between all the family members, and it has to be unanimous. It has to be something which all the members of the family decide this has to be done. This is important, friends, because once there is a partition of the family, then probably it will be very difficult to again reconstitute the old HUF again, because there is no concept of partition, partial partition. There is only complete partition. The following legal aspects, again, friends, have to be kept in mind in regard to partition of HUF, which also has to be kept in mind while partition of HUF, which are as under. Distribution of the assets of an HUF in the course of partition would not attract any capital gains tax, as it does not involve a transfer. On the basis of the same reasoning, friends, distribution of assets in the course of partition would not attract any gift tax. There is no question of gift tax because it is not there. Further, friends, there is no question of clubbing of income under Section 64 of Income Tax Act, as it does not involve any direct or indirect transfer. Please remember, friends, the family property is given to its members, so it is no question of any transfer. The income or the property would remain to be continuing with one of the family members itself. So there is no question of capital gains on the same. Please remember, friends, receiving and giving gifts. There is absolutely no problem of the same as far as HUF is concerned. HUF can receive gifts from anybody, especially if it is any gift which is received from a co-parsoner, even a non-co-parsoner, and even a stranger, it can receive gifts from. Absolutely no problem. And this was expressly provided in the case of CIT versus K. Satyendra Kumar case 232 ITR 360 of the Supreme Court. What matters is the intention of the donor or the testator. The property given is for the benefit of the family as a whole. Whenever a person who gives the property as a gift, he should not, think about the intention. The intention is always for the family, and his intention is to give a gift for the well-being of the entire family. The donor should clearly indicate that he is donating the gift to the HUF. So this particular indication, this clarity of the donor is very, very important. This is expressly provided in the case of CIT versus Maharaja Bahadur Singh and others in 162 ITR 343 of the Supreme Court. So this is very, very important, friends, that as far as HUF is concerned, receiving of gift is absolutely no problem. Not only that, friends, you have to remember that HUF can also give gift to its co-parsoners. What about Succession Act? The Hindu Succession Act 1956 has now been amended after 2005. The effect of this amendment is that all the daughters which are married or unmarried before 2005 also, and male members of the HUF are also co-parsoners of the HUF. The married daughter is a co-parsoner of the HUF of the father, while she also becomes the member of her husband's HUF, but not as a co-parsoner. Please remember, friends, a married daughter today also has now rights of the father's HUF. So it is not that just because there are male members, then the daughter does not get any right towards the ancestral property of her father or her grandfather, as the case may be. A married daughter or any girl member is a co-partner of the HUF, and hence she has the rights of the ancestral wealth which belongs to the family. So friends, these were some of the few slides which I wanted to share with all of you today. And
Sure, sir. So can we take questions, sir? I'll just
yeah,
share my
sure.
screen.
These were some of the few slides I wanted to share with all of you. And if there are any questions, I'll be more than happy to take up the same. Otherwise, yes, then let us take up all the questions, please.
So we have some question compiled, sir. Are you able to see my screen, sir?
Yes.
Yes. Can we take one by one, or? Is my screen visible, sir?
Yes.
Read it for you, or you can read it for yourselves.
Yes, I can read it. The first question is, in case of HUF, where the shares of the beneficiaries is known. Hello? Can you hear me?
Yes, sir, we can hear.
I'm just reading out the questions. The first question is, in case of HUF, where the shares of the beneficiaries is known and one of the members is taxed at 42.74%, what is the maximum marginal rate for HUF? 30 plus applicable surcharge or 42.74%? Sir, we are talking about HUF and we are not talking about a trust. In case of a trust, then the concept of this is applicable. In my personal opinion, the rate of tax for HUF will be 30% plus applicable rate of surcharge. Second question, can we create HUF by will, and difference between bigger HUF and smaller HUF? Answer is, HUF cannot be created by will. HUF can only be created by way of a family. So first, Hindu undivided family. So that is what by nomenclature itself it means it has to be a family, and when a person gets married, he creates a family, there has to be a children, and there will be a family. So there is no concept of will creating of HUF. Second, difference between bigger HUF and smaller HUF. HUF is a family. Once there are more and more children which come into HUF, it becomes a bigger HUF, and smaller HUF is some which are having, but minimum you need a husband and a wife, and more children, that becomes a bigger HUF, but it is just for the nomenclature. Whether HUF includes Muslim undivided family? Answer is no. HUF by itself, Muslims are governed by the Muslim law, and there is a separate law which governs the same. As far as Hindus are concerned, they are governed by HUF. So Hindu undivided family by itself means Hindus, and it is not applicable to Muslims. What is the difference between member of HUF and co-partner? Answer is the members of the HUF. What is the difference between members of the HUF and co-partners? Co-partners are people who are, when we say members of HUF and co-partners, at some point of time we use it interchangeably, but co-partners are the people who have the right to receive the wealth or right to inherit ancestral property. Those are the people who are called co-partners, and members of the HUF are those who become a part of the HUF, but at some point of time they don't have access, or they do not have the right over the ancestral property. So for example, a person can have a co-partner is a person who becomes a part of the HUF. For example, a husband, his wife, and his children are all people of the HUF. They are members of the HUF. The Karta is also part of the HUF. He is the head of the family. Can we create HUF with gift? Can we create HUF with gift by a family member or Karta of family? Can a lady member become Karta? Answer is first is yes. We can create HUF with a gift of a family member. So a family member, for example, an uncle or an aunt can give some gift to husband and wife, and yes, that can become part of the HUF, and that is the family property. Or karta of the family? Answer is yes. A karta of the family can also give a gift to the HUF. Answer is, can a lady member become karta? Answer is, as long as there is a male member which is present in HUF, he remains to be the senior most male member of the family, remains to be the karta of the HUF. If there is no senior most male member, then the younger male member can also become the karta of the HUF with the consent of other members. But as long as there is a male member, a lady will not become a karta, and a lady member will remain to be a co-parsoner, and she doesn't become a karta. Dear sir, as a part of partition of HUF, dear sir, as partition of HUF is not allowed income tax, is there as there is a dispute of a big HUF between a member and the rest of the family, how to take it forward? Answer is, friends, you are absolutely correct. Whoever raised the question, partial partition is not allowed. As long as there's a dispute, I think the property remains to be, sub judice. And as long as the court does not give a final answer, I think one needs to wait, because you cannot bypass the legal system of the country. You have to wait till the court gives the final decision. And once the court gives a decision, question. In one of the partnership firm, HUF is one of the partners in HUF capacity, and karta of the HUF in his individual capacity also as a partner along with his two more other partners. Bankers are now objecting for this to remove the HUF as a partner. Please throw light on this. So the answer is, again, the answer is with the bankers, because it is for us to understand what is behind the banker's mind. But maybe to have because of certain KYC regulation, or maybe because of some internal guidelines, because as far as law is concerned, there is no prohibition as far as what you have mentioned. But why the bankers are objecting to remove the HUF is something which you need to understand from the banker itself. But from the plain reading of the question which is mentioned to me, I personally feel there should be no problem. What is the advantage of blending the individual property into HUF as compared to gifting the individual property to HUF? The answer is, friends, when you say blending the individual property into HUF means when you blend it, you please remember you are blending it in the form of gift. So there is no concept of comparing it. So blending the individual property means you are bestowing it, or you are contributing by the nature of a gift. So there is no question of comparison. The same thing is called gift. So when you give up the property, when you give up your individual property by way of love, affection towards the common pool of an HUF, that becomes an ancestral, that becomes a HUF property, and there is no going back to that. So it then becomes a a family property, and you have to ensure that it is given by way of love and affection. Can a HUF give movable or immovable property to a co-parsoner? Answer is yes. The HUF can give movable or immovable property to a co-parsoner. Absolutely, there is no restriction. Dear sir, the next question I'm reading, friends. Dear sir, in a HUF following, there are the co-parsoners. There are the in HUF following a co-parsoners: Karta, Karta's HUF, Karta's elder son, Karta's elder son's wife, Karta's younger son, Karta's elder son's wife, Karta's grandsons from both the sons. Karta's elder sons have expired and his wife are getting separated from family and getting married. How to give their widow of the deceased kids share? Answer is you will have to do a partition of the property, because as I also mentioned during my slides, that as the family grows larger and as certain portion of the family also would like to have the property which is ancestral in nature, and now there is no concept of partial partition of the HUF. There has to be complete partition of the HUF property, and answer is definitely yes, but you will have to have a complete partition of the HUF property, and once the HUF complete partition is there, all the people who are co-partners would get share of the HUF property. Father has an HUF with his spouse and his adopted son as a co-partner. Son also has an HUF with his wife and children as co-partners. Both father and mother have died. What will be the status of father's HUF? Answer is father's HUF shall continue, because as long as there is an ancestral property of that father, father's HUF shall continue, and that father's HUF shall now consist of the person's son and also his grandchildren. So unless otherwise you do a complete partition of your father's HUF, that is the way out. One should do a complete partition of the father's HUF, and that ancestral property will then devolve upon co-partners who are of the father's ancestral property. In these days of assessment under next question I'm reading, friends. In these days of assessment under section 143(1), and in absence of scrutiny, is it necessary to file partition deed of HUF, and will the officer examine the issue and issue the order recognizing the partition? Answer is, friends, the law yet provides for the same. There is today no exception. So what you're saying is practically correct. What you're saying is practically true. But today the law provides me to do the same. There is no exception that the law has said by way of statute, don't do that. So it is my duty as a law-abiding citizen of the nation that yes, the same is required, and partition deed has to be submitted to the assessing officer to examine the same and issue the order of the same. I think it is the matter of time where some amendments may also come, but as of today, that is the requirement. I'm reading next question. If an asset is given to an HUF thrown in common pool, can it be clubbed in the co-partner's income thereafter? How to ring fence and guard this? Friends, please remember, once a person throws any kind of asset or any kind of movable or immovable property in the common pool, that remains in the HUF's hand. It remains to be as a right of all the persons who are in that particular HUF. It remains, even income which is derived from that HUF property remains to be taxed separately as the income of that HUF. So if you're asking me, can it be clubbed in the hands of the co-partners? The answer is, if it is given by way of a gift, if it is given completely by way of love and affection, and there is no concept of taking it back, and if it is given as a gift, there is no concept of thereafter clubbing. So answer is, how to ring fence it? Please ensure you take all precautions that, like any other gift, you do not create any rights, or you do not continue to receive any kind of income by way of the same. Once it is given completely in by way of a gift, and you do not have any kind of attachments towards the same, it will always become income of the HUF. Definitely, in case of an immobile property, you can create a document towards the same. In case of an immobile property, you can always have a thorough documentation which expressly provides. You can also probably get it registered and ensure that there is at no point of time at later point to say that it can be up in your hands. Next question. Assuming that HUF has invested in tax-free investments in section 80C and claim the same in its return, HUF has to hold such investments for 5 years. in case the partition happens within the period of 5 years, will there be tax implications in respect of investment? Answer is, friends, in case there is again a partition which is a complete partition or a total partition of an HUF, then everything and anything which is relating to the partition also would continue. Meaning thereby, if that particular investment which is made for a particular 5 years, you will have to see the conditions in case if you break that investment within 5 years, and in case you have withdrawn your investment in less than 5 years, then yes, then even after that probably you will have to see that if it remains to be taxable in the case of an HUF, then yes, HUF will have to pay the necessary taxes on the same. So friends, thank you so much for giving me a patient listening, and in future also, if there are any questions, I would request the organizers to share my name, number and email with all of you. I'll be very happy to take up any more questions in future as well.
Thank you very
Thank
much.
you so much. If there are any more questions, friends, I'll be happy to.
We'll definitely mail you and we'll be in touch with you.
Sure, sir. Thank you.
For the answers. Okay, thank you very much for your presentation and time and your passion to teach also, despite being in the helms of the affairs of the WIRC in the past. So I wish you all the best, sir, in your future endeavors, so that this is a special topic. So special thanks to you, because not
Thank
many
you so
people.
much, sir. Thank you for inviting me, and thank you so much. Thank all the council members of SIRC, sir.
Thank you, sir. We'll move on to the next session. Friends, I'll now request Shashank Patki sir to take up the cooperative audits and the professional opportunities. Sir, welcome you. And I take this opportunity to introduce you. She is a chartered accountant since 1983 with an experience of 37 years. He has wide experience of audits of various trusts, companies, banks, and government companies. In addition to statutory audits, he has also carried out special assignments for government and other companies like analysis of costing systems, review and drafting of audit manual, accounts manual, etc. He is a consultant and auditor to many of the large urban and multi-state cooperative banks. He also worked as an arbitrator on behalf of Commissioner for Cooperation. He has carried out investigative audits on behalf of banks. His reports have been relied upon by the Central Bureau of Investigation and Police Department. He is a regular contributor to many publications on technical subjects. He has also written a series of articles on trust-related issues and solutions. With this background, I once again welcome you, very experienced and seasoned chartered accountant, and your knowledge, experience, and erudition will be shared, will be immense help to the members. Over to you, sir.
Thank you very much. Thank you very much for my kind information about me. Actually, about one thing, audit of cooperative banks is a subject which is very close to my heart. So I am thankful to SIRC for inviting me to such a this thing. And again, I would like to share one more thing. Basically, I am from Pune. So I am from WIRC, but for your kind information, I was born in Hubli. So originally, I am from SIRC. By destiny, I have come to WIRC. Otherwise, I would have been in SIRC.
Thank you.
Okay, sir. Now I will share my presentation.
Yes. Selva, sharing the PPT.
Sir is sharing the PPT, and can you move to the PPT, ma'am?
Yeah.
Yeah.
Sir, you are sharing it, right, sir, or else do we need to share it from our end?
Anyway, If you are sharing, then also okay.
No, I given you the presenter rights, so I thought you are sharing it.
Yeah. So I
You
will try
stopped
to
your
share it.
video now. Can you share this PPT and video again?
Yeah. Hi then.
It's not getting selected.
I will share it.
Screen
No
is
worry.
not-
No, I will share it.
Yeah, please. Yeah, because here it is not getting selected.
Just turn on your video alone, sir, and
Yeah. Now I think you have shared this.
so you can see the PPT, right, sir?
Yeah.
So can we go to the next?
Yeah.
Yes.
Actually, can I change this or you will have to change the slides? Hello?
I'll change it, sir. You just say next, I'll change the slides, as you say.
Yeah. Actually, when we are talking about cooperative banks, there are different types of banks actually. There are state and district cooperatives, then primary cooperatives, urban cooperative banks, and primary cooperatives, rural. The example is like Chhattisgarh Rajya Sahkari Bank Maryadit, or it is Maharashtra State Cooperative Bank. And primary cooperative urbans are just like Saraswat Bank, like what we are talking. It is the #1 cooperative bank of India, as well as two very small banks, Angola Urban, I have taken from Maharashtra. So that is a very small bank. Those are primary cooperative urban banks. Then there are primary cooperative rural. That is that Mulapkodi Cooperative Rural Bank, etc. So there are basically three types of banks. So now actually we'll talk about the primary cooperatives, the urban cooperative banks, because when we are talking about the opportunities for chartered accountants, they are more in that urban cooperative banks. Next.
Selva.
Yeah. Actually, when we are talking of cooperative, urban cooperative bank audit or cooperative bank audit, first, I think we should understand what is the difference between other audits and cooperative bank audit. When I'm saying cooperative audit, let us think about the cooperative bank audit. First difference is that in case of company audit, basically it's objective reporting, and in cooperative audit, it is subjective reporting. Objective reporting means basically what we are doing. We are reporting on financial statements. We are commenting on the true and fair view of the balance sheet, as well as the true and fair view of the profit or loss of the organization or that company, and cash flow statements. That is basically related to reporting on financial statements. Actually, I am working in Pune, so basically we are working in multi-state cooperative banks as well as cooperative banks covered under MCS Act. But when I have read all other states' acts only, in Sanskrit they say, Sarvadeva Namaskara Keshavam Prati Gacchati. Means, if you pray one single god, whatever it may be Ayyappan, it may be Ganesha or something like that, everything goes to the ultimate god, that is Vishnu. It is something like that. Various cooperative societies act, they are formed at different times. Like Maharashtra Cooperative Societies Act, it is 1960. Then Karnataka State Cooperative Societies Act, it is of 1959. Tamil Nadu Cooperative Societies Act, it is of 1981, made effective from 1988 when they framed the rules for that. But everywhere, if you see, there are parallel provisions in this act, and wherever they are saying it is basically when we are reporting on financial statement, it is objective reporting. But in case of urban cooperative banks, you have to report on those financial statements also, because that is the basic thing what a chartered accountant is doing. He is certifying the true and fair use of the balance sheet and profit and loss account on which the third party relies. But here, there are certain subjective reporting. Additionally, certain areas have been included. Different acts, MCS Act or Karnataka Act or Tamil Nadu Act, and they have given different aspects which have to be covered in that. What they cover? Basically, an auditor has to cover, in addition to reporting on financial statements, he has to cover his comments on operational efficiency, good governance, and ratio analysis. I don't know how it is covered by a chartered accountant, but as far as cooperative bank audit is concerned, or rather cooperative audit is concerned, they expect the auditor should be everything. He should know everything. He should be a CA, he should be a ISA, he should be a forensic auditor, and he should know each and everything. The salient features or salient provisions in the different acts actually are covered in the ensuing paragraphs. So we'll talk about that there only. Here, the purpose of audit. We do audit as it is a legal requirement, and in that legal requirement, the purpose of audit in any other audit, it is to opine on true and fair view. That is the basic concept. But here, specifically, they are saying that you should also detect frauds and errors. So John Lindsay once he had said, the auditor is a watchdog, not a bloodhound. But this Cooperative Societies Act, I think they don't believe in John Lindsay. They feel that we are supposed to detect frauds and errors also. I have seen various state acts and something like that. In Maharashtra, actually, they are one step ahead. I think they are more pragmatic because there they are saying you should detect the frauds and errors. That is there in every act. But in Maharashtra, actually, they have put a responsibility or onus on the auditor to file the FIR also. So frauds and errors, the detection, that has been the main area. Even I will suggest you one thing: the Maharashtra Cooperative Societies Department, actually they are very pragmatic, and they have issued one audit manual where so many chartered accountants from WRC and all other people they have contributed. So I will suggest that you can refer to that particular manual also, even though there are certain provisions relating to NCS. But as I said, most of the provisions in other acts also, they are parallel to those provisions in Maharashtra State Act. So that audit manual can be a good help for planning. Here in this particular case, what happens if when you are doing any audit, we are having different planning definitely for any audit. But as far as cooperative societies audit or cooperative bank audit is concerned, a lot of planning is required. That I will come to next slide when we will be talking about the salient features. The company audit or trust audit or any other organization audit, that is based on the books of account and documents only, because we are going through the books of account and documents which are produced for our verification. And in some cases, as you are aware, because in many cases the documents are not made available to us because the client doesn't want to, or those documents are not available, and because of which, if we are not able to come to any conclusion, we either qualify or we put a disclaimer in our report. But here, in cooperative bank audit, it won't be only sufficient for as far as compliance of the duty bequeathed upon you. Here, there is one specific section I have referred to, that is the MCS Act, that is 81(3). But there are similar sections and similar rules in even all the South Cooperative Societies Act only. There they mention that the auditor, he has got power for personal inquiry. Whose personal inquiry? That is of the existing as well as past employees, existing as well as the past members, and the auditor has got a right to verify the books of members also. Generally, when we are auditing any company, shareholders' accounts or shareholders' books, they are not subject to audit, or we are not supposed to look into that. If we ask a company, you show us the books of your members, so you don't get that. But in case of cooperative bank, you have got that power to verify the members and past employees' record. Here, what I am saying is when you have got a right, the right is attached with the strings, and those strings are very strong. So here they are putting a duty on you. In case you are auditing any cooperative bank and you feel that there are certain things which could be seen well, if you go through the books of accounts or other records with the members, employees, something like that, then you should do it. I am saying should. In case of other things, it is may. That is your one of the audit techniques. But as far as any cooperative bank audit is concerned, it is a duty cost on the auditors also to go through all these records and come to any conclusion based on that. Because as I said, if detection of frauds and errors, that has been the main area. Maybe it is one of the reasons that in many of the cooperative banks there are various frauds. It is not that in national banks there are not no frauds and something like that. But unfortunately, in cooperative societies there are certain bad elements. There are stray elements, but they are there because of certain cooperative banks. They have come into problem. So government or any cooperative department, they want to curb that practice and they want to bring more controls. As such, this particular duty has been cast upon the auditors. Then, if we talk about the reporting, reporting is mainly to shareholders. In any other case, it is the shareholders or the stakeholders. But in this particular case, if you go through any act, any cooperative societies act, even whether it is a multi-state cooperative societies act or any state act, there the reporting is mainly to the registrar. If you read the act and rules, there are more references to the director audit or registrar cooperative audit by whatever name they are calling. So they have got the power. The reports are made for them. The registrars or directors, they go through your report And after going through your report, they can ask you questions, or if at all there is any fault on your side, they can question you and they can make you responsible for these things. If you see any cooperative bank's annual accounts, there it is mentioned. Generally, in case of companies, we approve the accounts or we approve the report account along with the reports. But in case of cooperative banks, you go through any annual account of any bank, there basically members' power is only to consider the report. What is consider? Means if the member, if any member doesn't agree with the auditor's report, or if he has got any problems, he can ask the questions, but he cannot comment on that particular thing, and there is no question of approval. So once that report is given by the auditor, it is final, provided the registrar doesn't have any problem in that. And registrar actually, he can go to any extent. And here I would like to tell you one particular instance. Basically, whenever we are doing any audit, that materiality concept, we have been taught since our articleship till we became C, and till now we are practicing. Materiality is of utmost importance. But in case of cooperative banks, even the registrar, when he goes to the report or if he comes across any particular matter, he doesn't look into the materiality of that. They say that materiality is not in amount. Materiality is in the substance. I'll give you a small example. We had audited one particular bank where there was a certain FD loans were given, and those loans were regular. But all the FDs were taken, the lien was marked, and that was taken into custody of the bank. But afterwards, certain different loans were given to those borrowers, some of the borrowers, and while closing their loan account under some settlement or compromise, these FDs, unfortunately, they were utilized for closing the other loans, keeping some balance in FD loans. So we commented on that thing, these are unsecured loans, and we provided for that NPA also. But the bank assured that we know all the borrowers, this has happened by mistake, and this is purely a clerical or through oversight, and that we will recover in the next year. But this point, when it was mentioned in the report, the registrar called me personally on phone, and he asked me, what has happened? Why at all you have not carried out a special report? Why you are not mentioning it as a fraud? That amount, I will tell you, it was only 2 lakhs of rupees. When there are loans of crores of rupees, in that 2 lakhs of rupees, actually we will ignore materiality concept. But here, that particular issue is not there. Materiality lies in the substance, not in the amount. Next, please. Next. Now, if we go to the salient features, why I'm going to the salient features, before we talk on anything about audit of cooperative banks, we have to understand what are the salient features of cooperative bank audit. Basically, it is searching and comprehensive audit to assess the extent of benefit to members and general public. Actually, it looks ridiculous if you are not practicing in cooperative bank audit, or if you are not practicing in audit of cooperative sector. This may look ridiculous. What we have to do, that what benefit the members have got, what benefit the general public has got. Generally, we have to see, or everywhere what we see, what our expenditure has been done, what our business has been done, whether it is as per the laws, as per the bylaws, and as per the objects of that company or trust, where the objects are specific. That here, actually, you have to see, you have to ensure, and you have to comment on the extent of benefit to members and general public. Here, I give you that example of 2 lakhs of rupees. So, whenever, again, there is one more difference. In case of companies and all these things, as I said, we talk about the overall macro effect. That is, whether the balance sheet gives a true and fair view, whether the profit and loss account gives a true and fair view of the profit and something like that. But if you go through any Cooperative Societies Act, if you go through any rules, and if you go through any circulars or whatever have been issued by the cooperative department, there they are talking about the transactions. You must have seen the latest LFR. Some of you must have audited the national banks and that new LFR. There was a lot of havoc on that. People said, this new LFR, it is creating a lot of problems. There are specific objective questions which have to be answered in yes or no. But I will say this LFR has come now. The cooperative department or all the cooperative acts, they are so pragmatic. They have thought of this long back, and they have just asked to comment on everything. If you are doing any cooperative bank audit since long, so this new LFR is not a problem at all. Here, the particular word used in all of these acts is that whether the transactions, whether they are as per the act, transactions whether they are genuine, whether there is any impropriety in the transactions. So they are not talking about the end result. In case of a national bank audit or private sector bank audit, we always say that bank audit is a balance sheet audit. Means we go through the loans, we see the recoverability of that, and everything we verify there. But transactions we verify by test check. Like how many challans we will be verifying, that will be by test check. How much KYC we will be verifying, that will be by test check. How many internal vouchers we will be verifying, that will be by test check. Here, actually, they have not said what test check you should apply. It is left to the benefit of, it is left to the decision of the auditor. But they are talking about the accuracy. They are saying whether there is any impropriety, whether there is any ingenuine expenses. So how you will ascertain? So for that particular thing, it is necessary that you cannot say ki I had applied a test check of 50% or 20%, like you see in the new LFR, where they are given how many cases you have verified, what is the quantum of that, what is the percentage of your test check, and something like that. So they just want to ascertain ki what exactly the auditor has verified in the bank, how many loans he has verified, something like that. But here in Cooperative Act, it is something more, that they want to have that particular onus of verification of all the transactions on auditors, and auditors should verify and should certify the accuracy. So here, what I'm saying is that when you are carrying out any audit of cooperative banks, it is not just like a common bank audit. Here, you should have your plan accordingly. Different acts, they are given different formats. Like audit report, our institute has given some format of independent auditors reports for multi-state cooperative banks or other cooperative banks. That I have given a slide in this, where that particular site is available. But in addition, every state they have got some different. I tried to read some that Kannada audit report format, but though I know something Kannada, but I cannot read it, so I could not read it. But definitely there are various items which are given as a questionnaire, and those questionnaires you have to answer with specific answers, either yes, no. If you say yes, then if at all you have carried out a test check, you have found out some say 5-10 cases, then if you are answering anything as a qualification, you can mention that yes, in the test check I have come across certain discrepancies and those have been enumerated here. But if at all you are saying no, we have not come across anything, so it is a specific statement. I am saying that it is not only a statement, it is a certificate. It is a certificate without requiring separate UDIN, but it is a certificate by itself. So here we have to take utmost care that our selection of test check has to be appropriate. Then there is one more provision in IPC, that is under section 21. Auditor is a public servant. What is the meaning of that? As I said, the auditor has been given certain rights and certain powers to go through any record. If at all you ask any member past or existing, and you ask any employee past or existing, and if they are not producing any record to you, then you can have police action against them, and you can ask for that record to be produced before you, because that is the power given by IPC. But always, as I said, when there is a certain right or certain power is given to you, it comes along with the strings. There are various case laws in cooperative bank audits where the courts have come to a conclusion that the bank or the members have suffered because of the actions of the auditor. Actions of the auditor means omissions or misreporting of the auditors. Then certain criminal liabilities as well as certain civil liabilities due to incorrect certification of final account have been cast upon them. Civil liabilities and criminal liabilities, it is only criminal liabilities, you understand, there will be a action under IPC. Civil liabilities, they may remove your name from the panel. But in some of the cases, even financial liabilities have been cast upon the auditors, and those have been recovered from them. So these are really silent features. So whenever you want to go for any cooperative bank audit, actually it's a very big task. As I said, I am fond of cooperative audit. There are various pitfalls and certain things which are to be looked into that. But as we say in Hindi, कि अपने पे भरोसा है तो ये दाव लगाओ. It is really an interesting type of audit. And so we'll go to next slide. Next. there are various acts and statutes which are governing cooperative societies. Generally, you see, if you are talking about any other client, there is only one single act. Income tax, I am not taking it as because it is a direct tax. Indirect taxes, that is different. But what is the basic act governing that particular organization? But if you take any cooperative societies, there are firstly, there is one Multi-State Cooperative Societies Act 2002. Here, all cooperative societies with objects not confined to one state, which were incorporated before the commencement of this act, under the Cooperative Societies Act 1912, or under any law relating to multi-unit, multi-state cooperative in force, and the registration of which has been cancelled before such commencement, and all multi-state cooperative societies. Those are covered under Multi-State Cooperatives Act 2002. If any bank has got even one small branch with other state, then naturally the particular states act where the HO is situated, it won't be applicable to that. And in that case, Multi-State Cooperative Act will come into force. So the actions or the powers of the registrar or director of that or commissioner of that particular state, they cease there, and the entire thing goes with the cooperative commissioner sitting in registrar, sitting in Delhi for Multi-State Cooperative Societies Act. Then this is one act where it is it talks about the societies and operations and something like that. Then secondly, the Banking Regulation Act 1949, and then Banking Regulation Amendment Bill 2020. It is basically, it was passed in Lok Sabha on June 2020, which are giving more power to RBI or UCB. That is basically, that amendment is basically in the wake of Mapusa Bank, CKP Bank, PMCKS, and so many other banks which have gone in liquidation, and because of which many poor members, they have suffered a loss. So for that, Banking Regulation Act was there, and in Banking Regulation Amendment Bill 2020, it has come in force. Here, I will just refer to one particular thing. As you are aware, that I will be talking in the case at the time of talking about the opportunities also. But here, actually, I want to talk about this particular aspect. In 27th April 2021, the RBI has issued one particular circular, and according to that circular, now the appointment of auditors. As you remember, in many of the cases, originally the power of the appointment of auditor was vesting with the cooperative registrars, and they were appointing from the panels. Then afterwards, they gave the power to the respective banks to appoint the auditor, and only that is to be communicated to the registrar and something like that. For the year 2020-21 financial year, only RBI asked the banks, you appoint the auditor, but you send that name to RBI for their approval. Now from 21-22, it is a basic change in the appointment of auditors. So here actually, I have also got one query on this particular thing. Now what they have done, that till this moment, any individual chartered account, any proprietorship concern could carry out the audit of cooperative societies bank, cooperative banks, urban cooperative banks. But with effect from 21-22, the RBI has given certain norms. They have bifurcated the banks into three categories, that up to 1,000 crores asset size, then 1,000 to 15,000 crores asset size, and banks with the asset size of more than 15,000 crores. We won't be talking about more than 15,000 crores because there are very few multi-state cooperative banks where there are limited number of auditors. So here, the first case that up to the 1,000 crores asset size, now they are asking that audit can be given only to the firms, that is partnership firms, that also with minimum 2 partners, one of whom should be FCA, and for more than 1,000 to 15,000, there should be 3 partners in the firm, 2 of them should be FCA. Then again, new partnership won't do, the partner should be associated with the firm for more than 3 years. There should be one ISA, there should be number of staff, and then again, what is your experience? On that, those auditors will be appointed. And now RBI has asked, earlier they had stated that 2 names of the such firms are to be selected by the bank, and those are to be sent to the RBI, means in the priority. If you are suggesting one name as a first name, then that name will be considered for approval. And if RBI doesn't approve that name, then definitely they will consider second name. That list has to be sent to the RBI earlier on by 30th of June, and now they have extended this period up to 31st July. Here there is one specific interesting case in this. Yeah, earlier all these things were done by the cooperative societies, or they are keeping a hand in that, saying that that the auditor which will be appointed by the bank should be from the panel maintained by the respective state's cooperative department. Now with this RBI circular, there is no mention of any such panel. They are considering the firms from the panel of MEF, that is RBI panel, whatever they are maintaining. From that they are considering. Till date, I don't know what will happen. Yesterday only our Deputy Chief Minister of Maharashtra, he has said that taking away powers from cooperative department will not be tolerated. Anyway, though it is a political issue, I think it is a practical issue which we don't know till the appointments for 21-22, and that also within 30-40 days it will be clear. Next. Now, as I said, there are state acts. The Maharashtra Cooperative Societies Act 1960, amended 2013, then Tamil Nadu Cooperative Societies Act 1983, made effective from 1988. Then Gujarat Cooperative Societies Act 1961, then Chhattisgarh Cooperative Societies Act 1960, Karnataka Cooperative Societies Act 1959, and so on. If you just see, if basically all these acts are there, but if you see all these acts, there is a national integrity. All the acts have been passed by the respective legislative assemblies of the states. Still, if you compare all those acts, more or less, they are just the same acts, and most of the provisions, only the sections and rules they will change. But there is a sort of national integrity in this, and you have to consider all those provisions while you are auditing the banks. Next. This is just a illustrative format of audit reports. I have not given that. This is the site of ICAI ORG where you will find this thing. Now, when we are auditing what I said, subjective and all, there are certain, I talked about the certain pitfalls or certain strings attached. So here, I want to refer to this Rule 27(2) and 3 of Multi-State Cooperative Societies Cooperative Rules 2002 in detail, because there are similar provisions in the State Act that I can just refer to. If you see what an auditor has to see, auditor has to comment. These are the comments which is as per the model independent auditors report, what we are mentioning. First thing is there, whether there has been any material impropriety or irregularity in the expenditure or in the realization of money due to the multi-state cooperative society. As I said, material, that word we have to think twice. Materiality is not as per amount, but materiality as per the matter concerned or the substance of the issue, what is there. So here we have to take cognizance of all the transactions, and we have to come to one conclusion whether really there is an impropriety. Because if you see impropriety, that word is a subjective word. What I feel that it is there is a propriety, you may feel that there is an impropriety. But again, you have to apply your mind and go ahead with that. Then again, the audit report shall also contain schedules. It is not only comment, they are saying schedules with particulars of all transactions which appear to be contrary to the provisions of the Act, the rules, or the bylaws of the multi-state cooperative society. There are similar provisions in other state acts only. But here, what I want to say, before we start the audit, it is not a normal audit. Here, first, we have to understand what are the provisions of the Act which are governing the particular bank which we are auditing. If you are auditing multi-state bank, you have to consider this multi-state cooperative rules and Act, then bylaws of the multi-state cooperative societies. Again, what happens is we are continuously auditing some of the banks. We are audited for 3 years. Again, there is some gap, and again we are auditing. So we feel we know each and every bylaw of that. But I'll just give you a very small example of this. In one of the bylaws where I was auditing, you know, generally shares are issued to the members, because without shares, members cannot be given any, members cannot get any loan. And in there is some share linking rules also. For secured loans this percentage, unsecured loan this percentage, and those shares can be written only after the loan is squared up. But now with this time when there is a problem of NPAs and all those things, the banks go for the settlements, and when they go for settlements, what happens? They tell people, you pay me this much amount and I will settle your account, and your shares I will adjust against the remaining balance. That remaining amount either I will write off or I will give a waiver. So in that case, what happens? Once that particular settlement is accepted by the board, you ask the members to submit his resignation. Immediately on resignation, that amount is credited to the loan account. The loan account is closed, and okay, everything is fine. But if you read some of the bylaws, because there were model bylaws, if anybody has not amended those model bylaws and still the model bylaws are there, in those model bylaws there is one clause. share capital will be refunded to a person who is resigning from his membership only after 30 days from the date of resignation. So this is a dilemma. You cannot repay within 30 days and you want to close the account now. So here, though practically it is correct action on part of the bank, but auditor's duty is that you should mention that particular thing, you should bring it to the notice of the chairman or the board, and you have to ask them to get the bylaws amended. But till then, you will have to mention about this in your report. So here it is very necessary that you have to read all the provisions of the Act, rules, and Multi-State Cooperative Societies Act. There actually, I'm always telling in our office, actually one person is just reading, because every day, I will come to the last point. Any other matter as may be specified by the central registrar. It is same in case of other also. Any other matter as may be specified by the registrar in this regard. What is the matter? Actually, every cooperative department, they are issuing circulars and notifications. It is just a bombarding. Because last time, I remember even last week in Maharashtra, they issued one particular notification. In Maharashtra, all the members, they understand Marathi. So you cannot give your report in English. All your report should be in Marathi. So you must know all these things. Even in one case, I was asked by one of the, after completion of my audit, one registrar just called me and he told me, "Kya boss, you have not covered one particular aspect." I asked him, which is that aspect? He said, "What is the reservation quota in the employees of the bank that you have not mentioned?" I told him, "Sir, I am a chartered accountant. Actually, I am not supposed to know." He said, "There is one circular according to which the auditor is supposed to go through that thing." So actually, I was not aware of that thing, but fortunately, I asked that registrar, if this is not available on any of your website, if at all you have got a hard copy of that circular, you please give me that circular, then I will give you one apology letter. Okay, I have not covered that thing. Fortunately, that circular was not available. But again, unfortunately, any of the department, they are not maintaining any compendium of circulars and notifications issued in this way. If that is not there, then what is to be done? So we should be aware of what your circulars are there. At least important circulars for last 3 years, 5 years, those should be referred to before we start any audit. Then another thing is that all transactions which appear to be contrary to the guidelines issued by. I am just stressing on all transactions. All transactions. They are not saying anything. You have applied test check, and if you have not found anything, you mention nothing is there, and they found out one the department or registrar, they find out one mistake and they come against you. So here that all transactions, that is secondary. The third one, okay, anyway, you are doing any money belonging to the multi-state which appears to the auditor to be bad or doubtful of recovery. Yes, that anyway we are giving. Then loans given by the society to the members of the board, that also we are verifying. Again, any violation of guidelines, conditions, etc. issued, or again here those guidelines, conditions, that compendium, but at least there is always every year there is one master circular of RBI for urban banks. It is issued by UBD. So that particular circular is always available and it covers literally all the matters. Generally in Maharashtra, they issue one cooperative diary where all the relevant circulars and this master circular, it is specifically published. If at all there is any such thing, then please get hold of that. Next. Now, if I come to that similar thing, it is Rule 1025 of Tamil Nadu Cooperative Societies Rule 1988. If you see, everything is just like same, and this particular rule, I will say verbatim, it is the same as per our 69(6) of MCS Rule 1960. This was formed in 88. Even after 28 years, they have not changed even a single word of it. All the sentences are just same. All transactions they appear contrary to the provision. Here, the second aspect is very much important in my opinion. Contrary to the provisions we have talked about, all sums which ought to have been but have not been brought into account by the society. How to find out this particular thing? Which ought to have been, have not been brought into the account. What is meant by that? Here, everybody has to apply his own mind. Even my one interpretation of this is that, suppose there is we are applying accrual basis as per accounting standards, but in some cases we apply cash basis. So whether something which is not accounted for in this year on cash basis, whether it will be covered in this, I don't know. But here you will have to not go through only books of account, but you will have to go through all the minutes and whatever record is available with the bank, whatever minutes from every committee or every board, and that you have to go through and you have to see whether there was anything which would have been recorded, which would have required to be recovered, and whether it has been accounted for or not. then all other things are just the same. So we'll go to the next slide. Here, again, Karnataka Cooperative Society's rules that they consider that same thing again, but here, somehow if you go to Rule 29.2, there are clauses A to K. Those clauses are there, and there they are mentioning you have to cover what? Here, what they are asking you to cover, details of programs and activities undertaken by the society. This is the job of the auditor. Then genuineness and propriety of transactions. Okay, that we have talked about. Again, what I said, recruitment and promotion of employees, their service conditions, and so on. So now what I was saying, the difference in audits of other entities and cooperative banks, this is this difference. You have to go through the recruitment policy, you have to see how they are promoted, you have to see their service conditions, whether they are followed. And in the rules, it is also specifically mentioned whether if by not following the service conditions, whether any action has been taken on the employees, whether that has been correctly taken. So actually, what you are going to verify, that is to be seen. Then again, services rendered to members and utilized services utilized by the members. Again, it's a job by itself. So this transparency in transactions, account maintenance, and adequacy of computer updation, and any other matter specified. So if you see, if this is the case, that in this cooperative it is a very comprehensive audit, and here you are required to cover not only financial matters but operational management. You have to be a part of the management by verifying all these things, and that way you have to continue. Next. As I said here, that frauds and audit, those are the areas. So I have prepared this slide. It is basically that section 73(2), that is of Multi-State Cooperative Societies Act. But always, if you go through the audit manual or everywhere, there they are talking about the frauds. If at all there is any fraud in which is not found out by the auditors, and if the registrar finds out that those frauds, then the auditor is held responsible. In Maharashtra Cooperative Societies Act, then again there is one peculiar provision. It is a specific circulars also on that. What they are saying is that it's very interesting. The auditor is supposed to, when he comes across any fraud, he has to submit a special report apart from his normal report. Then that special report is to be submitted to the registrar. He has to take a permission of the special registrar for that fraud, and then he has to file the FIR. The auditor has to file the FIR. So here, actually, you don't get any specific fees for this. It is covered only in your audit fees. So always you pray if there is no fraud, because otherwise, if there is any fraud, you will file a special report. You take permission of the cooperative registrar. Then you go to the police department. Police will insist for why you want to file a FIR, and you will spend time there. And again, at least once you have to be in the court where you have to be a witness. That is also a closed room witness. So that particular thing is there. So again, if you see LHR also, now they are talking about the frauds. They are talking of red flagging of accounts. Actually, this red flagging of accounts, that is 2015 RBI circular is there. It is not applicable to UCBs. But if you read the Act and the various rule provisions, actually they are talking about red flagging, not in specific words. But you have to cover this fraud particular aspect in your audit also. Next. If you see the cooperative bank university, this is just for the seeing what are the opportunity for that. If you see, this is as per the offset surveillance report of RBI 2015 and other report 2021. There are urban cooperative banks of 1534 and rural cooperatives are 96,615. So there are total cooperatives of 98,146 in the country. So this is a large scope for auditors to carry out the audit of cooperative banks. Next. Now here just I have tried to have a geographic distribution. If you see Maharashtra, what I talk about that 1954 and something like that, out of that around 30 or 40% those are in Maharashtra, then Gujarat and Karnataka and Tamil Nadu. Karnataka is the third largest state, so they are having the cooperative banks. Next. Now what are the, I will come to professional opportunities because my time is getting over. So here I have tried to make one SWOT analysis. What is the strength? Because there is a lot of professional opportunities. I will be talking in the next slide, but I will just cover it in 5 minutes. Basically, what is the strength of the chartered accountant to carry out a cooperative bank audit? Basically, we have got a knowledge, and more than that, we are capable of interpreting the law and its applications. So that is the foremost important strength what we are having, why we should go for cooperative bank audit. Then secondly, aptitude towards risk analysis. Because when we are talking about the fraud, so in fraud, basically you have to analyze the risk, try to mitigate that particular thing, and whenever any risk persists, you have to see whether that risk has affected or it has resulted into any fraud, and if so, whether you are covering that particular thing. Then what is the weaknesses? Weaknesses, as I said, slew of changes, updates and guidelines, notifications, etc., not readily available. Any cooperative department, I am making a blunt statement, any department doesn't have a compendium of whatever guidance and notifications are given. Suppose one guidance is given, it is amended, say 2-3 years afterwards, then there is no mention, and which is the latest, because whatever circular you will be finding, whether it is the latest or whether there is anything overriding that particular thing, that you have to go on reading and nothing else. Then duality of control, that is now that RBI and state registrar or central registrar, there are contradictory notifications. As you are aware, last time, the last date for cooperative audits in Maharashtra, it was extended up to December because of COVID situation. Then RBI issued one particular circular, no, you have to submit all your thing in that form 30 in by 30th September. So a lot of banks from Maharashtra, they made appeals to RBI, we have got actually time limit up to 31st December. After a lot of things, the RBI governor, he was very happy and he said, no, you can give it to 31st of December. So if at all there are any contradictory notifications, to whom to listen to? Because as far as when we are auditors, we are answerable to RBI as well as we are on the panel of the state registrars or central registrar. So there, what answer we have to give, that I don't know, because there till who is more powerful, that is yet to be tested. Then future of empanelment, as I mentioned about that circular, when that circular doesn't talk about your empanel number of the state, whether there will be any future empanelment or whether that empanelment will be only for the society, for banks, what is the position, this question is still unanswered. Then opportunities. Opportunities is that basically CS can bring sophistication and value addition. Basically, there are two technical directors in any cooperative bank. Mostly they are chartered accountants. On now, the RBI has introduced one system of board of management. Again, that is a contradictory thing, which I feel there will be a lot of disputes, because board of management has to suggest certain things to the board of directors. The board of directors can reject the suggestions of board of management, but again, they will have to give reasons. And after all, the registrar will be asking the bank why at all those things were not taken into account. So in this particular case, the CS can bring sophistication and value addition by being as a directors of cooperative banks or being in the board of management of the urban cooperative banks. Then there are various assignments other than only statutory and concurrent audits that I will be talking in the next slide. Then what is the threats? Threats is first is that risk of fraud, misappropriation or impropriety not getting detected. For fraud, yes, we have got RFID codes and all those things are there. Then we know how to find out the frauds, misappropriation. But impropriety, when it is a very subjective thing, one person feels it is having a propriety, another feels it is not having the impropriety. So here, special caution is required. That is actually a threat, because it may cost you your certificate, your disempanelment or something like that. Then second threat is that multiple agencies having control, as I said, possibility of overlooking of some compliance. Because RBI might have issued certain circulars which might not have been complied with, or cooperative department might have issued certain circulars, those might not have been complied. Or there may be a case even that you have complied with one particular authority's circulars or notifications and you have overlooked another. So that is a threat. Okay, coming to the last slide. Next. Now, what are the opportunities? When we talk about the opportunities in cooperative banking, generally we talk about the statutory audits only. Or what else we talk? We talk about the stock audits. We talk about the concurrent audits. We talk about the systems audit. There is an internal audit. I'll just tell you one thing. In case of major banks, now RBI has issued one particular circular that their risk-based internal audit, that department will have to be set up by the respective banks. It is for the larger banks having more than 15,000 crores, but that particular thing is there. So in future, it may come to smaller banks also. So there, whosoever forms of chartered accounts, they were doing internal audit. So that is not there, and it will have to be appointed by the banks. But again, we are chartered accounts, so we should look at this particular opportunity. Okay, we were doing internal audit externally, but now if the bank is going to set up an internal audit department of its own, you have got a very good chance of getting recruited there, because all the chartered, they are not going for practice. Some of them, they want to go for employment. And if somebody has got a flair for bank, because I got a flair for banking, bank audits and something like that. If somebody is having that, and if it is not possible to practice, then they can have this particular opportunity which is going to be opened up. Then statutory audit, yes, you have to get in. Now, what are the other areas? I will cover in just 2 minutes. One is the training and development of accounts and audit staff of bank. There are very small, and there are many small urban cooperative banks with their asset size of less than 25 crores or less than 50 crores. There basically it is not possible for them to get a trained and proper account staff. Though those people, they are really genuine, they are very honest, and but still they don't know. Here a chartered account can have training and development, because I had taken certain when NPA was issued, NPA circular came into force earlier. So that time I had taken various seminars on NPA for the staff and for NPA management of the directors. So this is also a very good opportunity. Then again, credit appraisal. Banks are doing credit appraisal, but what I said, in case of small banks, even I am doing some credit appraisal for banks on their behalf after a particular certain limit. So this credit appraisal, if you have got a flair for credit appraisal, then you can do it externally, and you can help the bank in seeing that their loans are ab initio good loans. Then financial analysis and reporting formats akin to management audit, that also can be done. Then if you see there is a marking system in cooperative banks, so a lot of marks are given on procedural things like whether there is a proper loan policy, whether there is any investment policy, etc., and whether those policies have been updated from time to time. Actually, if you are working in a bank, means I'm talking about the bank staff, when they are working in that, they feel, okay, I have got a loan policy, I'm going ahead with that. They are not aware what has happened, or even they may change their actually loaning thing in practice, but loan policy may remain as it is. So that particular loan policy, investment policy, drafting of that, review of those policies, suggesting changes in that, considering all the notifications, RBI guidelines, that can be a very good opportunity for chartered accountants. Then again, risk analysis of credit portfolio, deposit liabilities, investment portfolios, because every bank is having their exposure limit, and they don't have, many a times, they don't have the sufficient staff to take care of this particular aspect. So here, this can be done. And the last but not the least, it is the revival of SIRC banks. I will tell you a very small example of mine. I was appointed there was one SIRC bank which had gone into liquidation, and I was appointed to help them on that. So actually, it was a very nice experience. I worked with them for 19 years, though even if as an advisor, consultant on the board. And in 19 years, I actually talked to the RBI, and I got there more branches, and that bank is now running very nicely. Keeping aside this modesty, I will say that actually I learned a lot many things by that particular assignment, because always we sit on the other side of the table and we see what is wrong and what is correct and something like that. So sitting on that side and helping the bank, that is also, I feel now with this current scenario where a lot of banks, they are going for liquidation, they are in problems in those particular things. So revival of SIRC banks can be an excellent opportunity for the chartered account. Next. Next. Actually, what I feel, we are chartered accountants. As I said, there are a lot of pitfalls, there are a lot many challenges, because apart from other audit, you have to do a lot many things, but still, we have to accept that responsibility. So I will end this lecture with Swami Vivekananda's these words: never say no, never say I cannot, for you are infinite, all the power is within you, you can do anything. It is applicable to all of us, all chartered account fraternity. Thank you very much.
Some 4 to 5 questions. Can we take it up now or else?
Yeah. I will try to be very fast. First thing is how to pitch for cooperative bank audits. Is there a specific website? I will tell you one thing: there is no specific website as such. Only thing is that you should be on MEF, you should be on bank audit panel, and up till now, you should have been on the panels of the respective state department. But with the circular of 27th April of 2021, actually what you should do, you should go for marketing. You should go to a cooperative bank. You should tell them what is your capacity, and then that bank, you see that that bank appoints you. Your name is sent to the RBI for approval, and when that RBI approves, it can be then it is as far as statutory audit is concerned. Internal audit, concurrent audits. There, certain banks are maintaining panels, so you can apply for those panels maintained by the respective banks. Small banks, major banks, many banks are maintaining panels. So you go to them, just go for stock audit, however so small it may be. You just get acquainted with the people, acquainted with the bank, and go ahead. Then how it is different? Public servant under section IPC from auditor. No. Here there is a specific difference. Auditor of PSU or PSU bank, you have a responsibility only as a chartered accountant. You have a responsibility only as an auditor. If you any mistake, you are responsible. But you don't have any powers like public servant under IPC. Public servant under section 21 of IPC, it gives you specific powers. So specific powers are to verify the members' records, and again there are responsibilities. If there are criminal liabilities, those are there. As far as audit of PSU banks, it is a plain statutory audit. Then how to get multi-state cooperative societies audit? Okay, let me tell you in this particular thing what happens. It's a bit difficult to get multi-state cooperative societies. Why? I will tell you. If you take 10 multi-state cooperative banks, first 10, in that 9 are in Maharashtra and 1 in Karnataka. 1 is in Gujarat, sorry. 9 are in Maharashtra and 1 in Gujarat. But in multi-state, generally what happens is that particular audit is given to the bigger firms. So getting that audit for smaller firms would become a bit of a problem. Nowadays, what has happened? Many of the multi-state banks, now they are appointing as a joint auditors. Because many cases we are either 2 joint auditors or 3 joint auditors. So that is there. But you can do one thing. You can increase your firm, you can increase your partners, you increase your experience in bank audit, and then get registered with central registrar. That is just a formality, but basically, I will say market with the multi-state cooperative bank. Then second one, this board of management. Board of management, yes, actually it is going to be a very big problem practically, because I am dealing with certain banks. I am doing consultancy to cooperative banks on revival or taking care of all other things apart from audit. So it's a very big problem, because what they are asking now, you form a board of management, and in that board of management, the chairman of that board of management should not be the chairman of the bank. And these are again professional things here. Actually, there is a very good opportunity for chartered accountants to go on that board of management. But again, how it works, I am not sure, because board of directors, they are having supreme power. Board of management, they have been given advisory powers. But what happens if suppose any loan is to be given, that board of management says this cannot be given. The board of directors still they can sanction that loan. They can override that particular thing, but they will have to give reasoning for that. So here, what is going to be a practical thing that will have to be seen. So basically, it is based on that RBI Banking Regulation Act 1920 amendment that talks about this board of management. But again, I will say we are chartered, so it's an opportunity for us. Go to the bank and see if you are inducted in that board of management. You will get that very nice experience. Then audit of cooperative banks by CS are mandatory. Audit of cooperative banks by CS, yes. Urban cooperative banks, I am talking about urban cooperative banks. Urban cooperative banks, now it is to be done by CS only, and that also I am repeating, it is to be done by the firms of the chartered accountants as per the latest circular dated 27th April 2021. Earlier, every proprietor was, again, there was a grading, in all your states, grade A, grade B, grade C, and who could do it depending upon the experience of that audit. But now, urban cooperative banks, you have to forget about it unless you have got a partnership firm, and that also with 3 years of opportunity. I am suggesting you, if at all you want to do, have a long-term planning, form the firms now, be there with 3 years, get the experience, and get those audits. Then NPA provisions, they when compared with banks, no. In fact, actually here there is one more thing which I will suggest. As far as NPA provisions are concerned, I am always saying, always the government is having some prejudiced view about the cooperative banks, because the NPA provisions as applicable to cooperative banks, they are stringent, and even in some cases, if what happens in their NPA, where NPA is unrecovered interest, that you are not considering. But in case of certain cooperative act, they are mentioning that unrealized interest that you don't take into consideration. So those are stringent. Then any restriction of number of years, yes. As far as statutory auditor, now with this new circular of that 27th April, one firm or one auditor can be auditor of one particular bank for 3 years maximum, and after that there is a gap of 6 years. So earlier, after 3 years, another auditor, and again that circulation was there, it is stopped. So now it will have to be 6 years compulsory gap. For concurrent auditors, there is no such restriction. You can be concurrent auditor of one particular for n number of years till the bank is satisfied and you are giving your duty. Thank you.
Thank you very much, sir. You have maintained the time, and also your slides were very self-explanatory. And you have tried to cover
Yes,
all the areas of this one to the extent possible, and your experience.
And what I
yes.
Sir, actually, as I said, I am very much fond of cooperative audit. So if any CA in any region, if has got any problem, just give my number. I'm always for their help. Nothing professionally, it's my personal passion.
Thank you very much, sir.
Thank you, sir.
Some members asked me, I have shared your graded profile also.
Yeah.
Thank you very much for your time and passion to serve the institutes. Thank you very much. And we'll move to, with your permission, we'll move to the next sessions.
Yes, sir. Thank you, sir.
So, members, we will move on to the third session, technical session for the day. Mr. Shajan will be taking will be speaking on the insights into the taxation of cooperative societies. So I'll take the pride of introducing him. He's a qualified chartered accountant since 2002 and part chairman of Thrissur branch of ICAI. Thank you for serving the institute, sir. A regular speaker of on taxation of cooperative societies and presented papers at various meetings of cooperatives across Kerala. Presented paper on the topic taxation of cooperative society to various branches of SIRC as well as Andheri Oshiwara CP Study Circle WIRC, an expert in project planning, business consulting and taxation. Was president of Junior Chamber International during the year 2011 and director and executive committee member of Kidney Federation of India. With this, I introduce Shajan to you. Thank you, and over to you, sir.
Thank you. A very fine good evening to all. Whether I am audible?
Yes, sir.
Yes, sir.
Okay. Good evening, my dear friends. Respected SIRC Chairman CA K. Jalavadi, beloved Secretary CA Pandaraj, other office bearers of SIRC, senior members, my dear professional colleagues and students. First of all, let me extend my sincere thanks to the organizers, SIRC Chairman and his team, for giving me such a wonderful opportunity to share some of my thoughts with regard to taxation of cooperative societies. The cooperative societies are now playing a significant role in the economic front of the country. In Maharashtra, Gujarat, Karnataka, Kerala, and Tamil Nadu, the involvement of cooperative societies are very much significant. There are a lot of issues with regard to taxation which are disputed in various forums. Hence, the issues involved in taxation are very crucial in current scenario. With this small introduction, I think let us move to our topic. I will just share my presentation.
Visible, sir.
Okay. Yeah. Is it okay?
Visible. You can continue, please.
Yeah. So our topic is taxation and relevant issues with regard to cooperative societies, with regard to direct taxation as well. Let us just briefly look upon the various kind of societies. The societies are societies registered under the Societies Registration Act or Travancore Cochin Literary, Scientific and Charitable Societies Registration Act 1955, etc. These are normal societies. And there are another category of societies which are cooperative societies registered under the Cooperative Societies Act under various state as well as central laws. Each state has separate laws as well as central cooperative law is also there, under which multi-state cooperative societies are being registered. When coming to normal societies, these are societies registered under the Societies Registration Act. This can be charitable societies, it can be clubs, association, or housing owners or apartment owners association. For the taxation purpose, these societies will be treated as either IOP or body of individual, and mutuality concept may be applicable to the some of these societies, that clubs or housing owners association, mutuality concept may be applicable. For the rest, it will be taxable. All other income other than coming under mutuality, it will be taxable under AOP or BOI. So such societies cannot avail the benefit of deduction under section 80P, because 80P deduction is eligible only to cooperative societies. Then let us move to the category of cooperative societies. Cooperative societies can be cooperative banks as well as cooperative societies as well. Cooperative banks are state cooperative banks, district cooperative banks, urban cooperative banks, regional rural banks, etc. All these are registered under respective State Cooperative Societies Act, but they are simultaneously registered under RBI Act also. So they are having RBI license. Such societies are known as cooperative. In a wider sense, such societies are known as cooperative banks. In these cases, 80P deduction will not be available for such cooperative banks, but they can very well avail the benefit of deduction under section 36(1)(7)(a) with regard to that deduction in respect of bad debts and rural branches, loan advances relating to rural branch. These cooperative societies can be eligible, but they are not eligible for 80P deduction. Then let us move to the category of cooperative societies. The cooperative societies are registered under Cooperative Societies Act. They are, some of the examples of cooperative societies are primary agricultural cooperative societies or primary agricultural cooperative banks, primary cooperative agricultural and rural development bank, multi-state cooperative societies, cooperative credit societies, then other cooperative societies, that is cooperative societies other than providing credit facility. This cooperative credit society means they are dealing with financial instruments that providing loan, accepting deposit, that are coming under cooperative credit societies. Other societies such as consumer cooperative societies, milk cooperative societies, labor cooperative societies, they are coming under other cooperative societies. And housing cooperative societies are also there. I think in Maharashtra there are a lot of housing cooperative societies registered. These are basically the category of cooperative societies. Even they are registered under respective state law, or if they are registered under central law, it will be covered under Multi-State Cooperative Societies Act. Then let us move to the taxation angle of cooperative societies. We are just concentrating on the taxation angle of cooperative societies alone. The main provision available for cooperative society is deduction under section 80P, and even in that 80P, the important section is 80P2A1, which deals with exemption for income, 100% income from banking or providing credit facility to its members. This is covered under 80P2A1. There are a lot of other provisions also that we will look into later. Then other matter is interest on investments. Then income from monthly deposit scheme. It can be called in various names. In some they are known as they are running as JITs, monthly deposit scheme. various names will be called for this, and income from cooperative housing society, then applicability of 269SS, 269T and 269ST. This area will be covered later on. Then applicability of TDS provision with regard to cooperative societies. These are the main topics which we are going to deal with in today's topic. Okay, then when moving to taxation, this date 1/4/2007 is very much important as far as cooperative societies are concerned, because this date divides a two regime. That means that before 1/4/2007, that is up to 2006-07 financial year, all cooperative banks, cooperative societies as well as cooperative bank were treated at par. But after 1/4/2007, when ATP4 was introduced, a division happened in the case of cooperative societies. That we will take later on. So 1/4/2007, before 1/4/2007, there was no confusion with regard to deduction under section ATP. But after 2007, it was restricted to some kind of societies, some kind of society. The cooperative banks has taken out from the ambit of ATP deduction. That we have already discussed up to 31/3/2007, ATP applicable for all cooperative societies, including cooperative banks. Then after the amendment came with effect from 1/4/2017, ATP amended by insertion of subsection 4. What subsection 4 says? ATP 4 says that the provision of this section shall not apply in relation to any cooperative bank other than a primary cooperative credit society, PACS, or a primary cooperative agricultural and rural development bank. But ATP is still applicable to primary agricultural cooperative societies as well as other societies providing credit facility to its members and which is not a cooperative bank. So by introduction of this section, lot of litigations arises whether the society is actually cooperative bank or cooperative society. So various interpretations came, and this was lead to a lot of dispute which is now lying under various level, from the commission, CIT level, CIT appeals level to Supreme Court level. Various cases are pending. In the case of other credit societies which are not having banking license, ATP4 is not applicable, and thus they are eligible for deduction available under section ATP2, various section under ATP2. Then what are the issues involved in the assessment? That is why the assessing officer is treated these banks, these societies as a bank, cooperative bank. Interpretation start, department version is that for classifying societies as a bank, the major lawns of societies are non-agricultural. In the case of a primary agricultural cooperative societies, they are department is saying that major lawns of the societies are non-agricultural in nature. Agricultural lawns are very meager, maybe 5%, 10%, or even less than 1% also. So they are the lawns provided for the agricultural purpose or agricultural allied activity is very meager. That is why they are saying that these are not these are not primary agricultural cooperative societies. So ATP2 A1 deduction cannot be available to such societies. Then another issue is accepting deposit and providing loan to non-members. Deposit was accepted and loans are provided to non-members. So they are coming at par with, they are treating at par with other commercial banks. Then C-class members are not to be treated as a member. Then accepting deposit, hence treated similar to bank. It is at par with the banks, other commercial banks. Using the word bank in the name of the society. Then mutuality is not applicable because the society is dealing with other non-members. So the mutuality principle is violated. So this deduction cannot be available to such societies. Then they are providing locker facilities like other commercial banks. They are providing check facilities. These are the major reasons raised by the assessing officer for treating these societies as cooperative banks. Then another major important area is treatment of interest on investment with other than societies. That the interest from cooperative societies is eligible for deduction under section 80P2D. But if the society is invested its fund with another cooperative, another bank or any other cooperative bank other than societies or any other institutions, such interest or dividends received other than from societies, it will be treated as income from other sources, and it is not as part of banking business, and thus it cannot be treated as income from business and profession. So ATP deduction is denied for such cases. These are the major issues coming up with regard to assessment of cooperative societies. Let us in detail analyze these matters. Let us just move to the definition under the Banking Regulation Act. The cooperative bank and the primary agricultural credit society shall have the meaning respectively assigned to them in Part 5 of the Banking Regulation Act 1949, in which cooperative bank means a state cooperative bank, a central cooperative bank, or a primary cooperative bank. Cooperative credit society means a cooperative society, the primary object of which is to provide financial accommodation to its members, and includes a cooperative land mortgage bank. This definition is very much important because when comparing to the definition under section 80P2A1, this word is very crucial, cooperative credit society, that we will look into later. Then cooperative society means a society registered or deemed to have been registered under any central act for the time being in force relating to the multi-state cooperative societies or any other central or state law relating to cooperative societies for the time being in force. These are the categories of societies: cooperative bank, cooperative credit society, cooperative society. And another category is, as per section 5 CC4 of Banking Regulation Act, primary agricultural credit society means a cooperative society, the primary object or principal business of which is to provide financial accommodation to its members for agricultural purpose or purposes connected with agricultural activities. So there are two limbs to become a primary agricultural credit society. That principal object or principal business should be is to provide financial accommodation to its members, and that too for agricultural purpose or for purposes connected with agricultural activities. And there is another condition, the bylaw of which do not permit admission of any other cooperative society as a member. If these conditions are satisfied, cumulatively satisfied, then it will be known as primary agricultural credit society. Then what banking business as per Banking Regulation Act says? Banking means accepting for the purpose of lending or investment of deposit of money from the public, repayable on demand or otherwise, and withdrawable by checks, draft, order, or otherwise. This is important because banking is defined under the Banking Regulation Act. It says that it is for accepting for the purpose of lending or investment. It is same as in the society as well, but for what? Of deposit of money from the public. From the public, if it is accepting money, then it will be called as bank. If it is not accepting any amount from the public, then it cannot partake the character of any cooperative bank. That is very important because in the case of cooperative societies, this acceptance of deposit are from the members only. It is not from any public. That is why it is coming out outside the purview of this banking. Then as per section 5C of Banking Regulation Act, banking company means any company which transact the business of banking in India. So for transacting the business of banking, RBI license is compulsory. It is decided in the case of Kanchana Gauri Mahila Sahagari Patpedi Maryadit and Cupam Urban Cooperative Society Limited, that the fact that the assessee accepted deposit from and provided credit facility to its members only, and yet this aspect has not disputed by the assessing officer. Assessee could not be held to be engaged in the business of banking, especially on account of assessee having no license from RBI. Therefore, claim of assessee not hit by section ATP 4. That means that since it is not covered under ATP 4, ATP 2A1 deduction is very well available to such societies. So this is also very important aspect with regard to eligibility of ATP 2A1. And in Shimoga Housing Cooperative, Shimoga Housing Society Limited versus CIT, ITIT Bangalore has given a detailed observation about the distinction between cooperative bank as well as cooperative society. Cooperative society being a cooperative bank means registered under Cooperative Societies Act of the concerned state as well as under Banking Regulation Act 1949. Then cooperative society other than cooperative banks are registered only under the Cooperative Societies Act of the concerned state. Cooperative banks, the word bank, banker, banking can be prefixed or suffixed to its name, whereas in the case of cooperative societies, the words such as bank, banker, banking cannot be used by cooperative societies. Here there is an issue because in our state Kerala, there are a lot of cooperative societies using the word bank. Actually, principally, they are registered as a cooperative society itself, and they are continuing as a cooperative society. But in order to obtain some status symbol, they have changed their name to society to bank. So they are not known as cooperative bank. But in various decisions, it was held that mere nomenclature will not is not to be considered to categorize the society as cooperative bank or cooperative society. The activity of the society should be taken and the registration condition of the society should be considered while deciding whether it is a cooperative bank or a cooperative society. So even if the name bank is there, that society, that institution can still be a cooperative society. It need not be a cooperative bank. In recently, the Supreme Court decision has come out in the case of Mavilai Service Cooperative Bank Limited. In that also, the name is cooperative bank, but for in that decision, the Supreme Court has come out with the ruling that ATP 2A1 is eligible if some conditions are satisfied by such society. So even if the word is bank used in the name, it is not an issue. But recently, the Reserve Bank has come out with a regulation, the direction that all the cooperative banks which has not obtained all the cooperative societies which has not obtained the banking license under the Reserve Bank of India Act, they have to change their name from bank to societies. So that direction is there. So I think all the banks should convert their names to societies. Then in the case of a cooperative bank, RBI is the regulating authority and it has the power to inspect overall functioning of the cooperative banks. Whereas in the case of a cooperative society, registrar of society is the regulating authority and has power to inspect overall functioning of the cooperative society. RBI is not the regulating authority in the case of cooperative society. And in the case of a cooperative bank, Part 5 of the Banking Regulation Act is applicable to cooperative banks, whereas in the case of a society, Part 5 of the Banking Regulation Act is not applicable. And cooperative bank cannot enter into or engage into any other trading activity, but cooperative society can enter into any trading activity. We can see that lot of cooperative societies are doing banking as well as they are running needy stores, they are running supermarket, they are running petrol bunks. So that lot of activities are there in the case of cooperative societies, other activities other than providing credit facilities to its members. And in the case of a cooperative bank, they can open SB account, current account, OD account, CC account, issue DD, pay order, LC, guarantee, or bill discounting, etc. as similar to other banks, other commercial banks. And in the case of a cooperative society, they cannot open SB account, current OD, CC account, issue check, DD, pay order, LC, or guarantee, bill discounting, etc. In the case of a cooperative bank, they can act as a clearing agent for check, DD, pay order. Whereas in the case of a cooperative society, they cannot act as clearing agent for check, DD, pay order, etc. In lot of assessment, the assessing officer says that since the cooperative society is issuing checks, they are at par. They should treat at par with commercial banks as well. But in this case, these checks are used only as a withdrawal slip. They are not as part of a clearing system. So we can argue in this sense with regard to this point. And when coming to the very important topic, taxation under section 80, deduction under section 80P, 80P1 says that where in the case of an assessee being a cooperative society, this is most important wording, cooperative society. Here it is mentioned as cooperative society only. Here there is no mention about it should be a primary agricultural cooperative society or other society. It should be a cooperative society. That is why the definition of the cooperative society as per the Banking Regulation Act is very much important. So in the case of a cooperative society, the gross total income includes any income referred to in subsection 2. They shall be deducted in accordance with and subject to the provision of this section, the sum specified in subsection 2 in computing the total income of the assessee. So 80P1 says that in the case of a cooperative society, the gross total income, if it is includes as mentioned in 80P2, such deduction will be available under section 80P1. So then what 80P2A says? 80P2 says, 80P2 having different subsection, 80P2A1, A1 to 7, 1 to 8, 80P2B 1 to 3, 80P2C 1 to 2, that consumer and other societies, 80P2D with respect to interest and dividend from cooperative societies, other cooperative societies, then 80P2E in respect of specified rent received by cooperative societies, then 80P2F interest on securities and house property income for specified societies as mentioned in 80P2F. These are the various section under which the deduction can be available under section 80P. Let us move to 80P2A1. 80P2A1 says that the sum referred to in subsection 1 shall be the following, namely, in the case of a cooperative society engaged in carrying on the business of banking or providing credit facility to its members. So a cooperative society carrying on business of banking or providing credit facility to its members, not to any other public or not to any non-members. It is providing credit facility to its members only. Such societies, the income from such banking activity or income from such activity of providing credit facility to its members is 100% eligible for deduction under section 80P2A1. This is applicable to almost most of the credit societies. Then other categories are a cottage industry or the marketing of agricultural produce. A cooperative society engaged in a cottage industry or a cooperative society engaged in marketing of agricultural produce grown by its members, or a cooperative society engaged in purchase of agricultural implements, seeds, livestock, or other articles intended for agricultural for the purpose of supplying them to its members. Then processing without the aid of power of the agricultural produce of its members, or the collective disposal of labor of its members, or fishing or allied activities, that is to say the catching, curing, processing, preserving, storing or marketing of fish, or the purchase of materials and equipment in connection therewith for the purpose of supplying them to its members, the whole of the amount of profit and gains of such business attributable to any one or more such activities, it will be deductible at 100%. In point number 6, it is mentioned that the collective disposal of labor of its members. Here there are a lot of labor contract societies are there, but they are not using their members' labor as an output. Only if they are using the members as their labor is, then only this deduction can be available. This is covered under ATP2A1. Then provided that in the case of a cooperative society falling under subclause 6 or subclause 7, the rules and bylaws of the society restrict the voting rights of the following class of its members, namely the individual who contribute their labor, or the case as may be carrying on the fishing or allied activities that we have previously discussed, the cooperative credit societies which provide financial assistance to its to the society or the state government. And when coming to ATP2B, in the case of a cooperative society, being a primary society engaged in supplying milk, oil seeds, fruits, or vegetable raised or grown by its members to a federal cooperative society, being a society engaged in the business of supplying milk, oil seeds, fruits, or vegetable, as the case may be, or the government or a local authority or a government company or a corporation established by or under central, state, or provisional act, being a company or corporation engaged in supplying milk, oil seeds, fruits, or vegetable, as the case may be, to the public, the whole of the amount of profit and gains of such business is eligible under section ATP2B. And when coming to ATP2C, if a cooperative society, ATP2C deals with other societies, that consumer cooperative societies as well as any other societies, a small lump sum deduction is available. If a cooperative society is engaged in the any other activity, either independently or in addition to those specified in A and B, that they are into the activity as mentioned in ATP2A1 or ATP2A or ATP2B, and they are involved in any other activities, then the following amount is deductible under section ATP2C. In the case of a consumer cooperative society, they can avail the benefit of deduction under 1 lakh of the total income, or in the case of any other society, they can eligible for a deduction up to 50,000. So these are lump sum amount. If they are having income from other activity for let us say 40,000, then they can avail the entire amount as a deduction. But if the income in the case of any other society is 60,000, they can avail 50,000 deduction, and 10,000 will be subjected to taxation under the society's tax slab. Then coming to ATP2D, here it is dealing with interest and dividend received from any other cooperative society. That a society invested in other cooperative society, either in the fixed deposit or as share capital, the whole of interest and dividend income derived by the cooperative society from its investment in any other cooperative society is deductible under section ATP2D. Here from the interest received from cooperative society alone is eligible for deduction under section ATP2D. If it is not from a cooperative bank, then the issue comes. That is the matter of litigation for lot of cases. Then deduction under section ATP2D would be allowed to an assessee after excluding any expenditure attributable to earning such eligible income as usual. Then ATP2E deals with some rents, income from letting godowns or warehouses for storage processing or facilitating the marketing of commodities. The whole of such income derived, such rental income derived, will be eligible for exemption under section ATP2E. Then in the case of ATP2F, in the case of a cooperative society, not being a housing society or an urban consumer society or a society carrying on transport business or a society engaged in the performance of any manufacturing operations with the aid of power, where the gross total income does not exceed 20,000 rupees. It is very limited, where the gross total income does not exceed 20,000. Other than the above societies, the amount of any income by way of interest on securities or any other income from house properties chargeable under section 22 will be available for deduction. This is ATP2F says. Then coming again to ATP2A1, there is a at the time of introduction of ATP4, there was a lot of confusion regarding the taxability of cooperative banks and societies. So department has come out with a circular number 6/2010 dated 20th September 2010. In the case of a cooperative society providing credit facility to its members, the whole of the amount of profits and gain of such business are deductible. From the assessment years 7-8, deduction under ATP will not be available to any cooperative bank because ATP4 comes into existence. Even regional rural banks will not be eligible for deduction under section ATP. A primary agricultural credit society or a primary cooperative agricultural and rural development bank will continue to claim the benefit under section ATP even after the introduction of ATP4. Then let us just look into the latest Supreme Court decision in the case of some of the Kerala cooperative societies, that Mavilai Service Cooperative Bank Limited and others versus CIT Calicut. It has come out just during, I think, December 2020. December 2020 or January 2021, this decision has pronounced. The main points are summarized here. ATP2A1 is eligible for profit from loans provided to its members. So it is very important. It is eligible only with respect to loans provided to its members. It is not necessarily for agricultural purposes. So if there is an primary agricultural cooperative society, it's providing loan to its members for agricultural purposes is very meager, even though they can claim the deduction under section ATP2A1, because if they are providing to its members alone, then there is no condition specified in under section ATP2A1. There is no condition stating that it should be an agricultural cooperative society. It just states that it should be a credit cooperative society. It should be a cooperative society. So if it is a cooperative society and the loans are provided to its members, then ATP2A1 is eligible. In the case of a loan to non-members, then for that portion, ATP2A1 is not eligible. And other important area which dealt with in this decision is that with regard to admission of nominal members. If as per the respective state act, the nominal members are also members, then they can be treated at par with regular members. There are a lot of cases, because in some of the societies they are issuing class C share, that they will be admitted as a nominal member. They can deposit amounts and they can avail gold loan, but they cannot avail any other loans. So such members are not eligible for any profit division, or they cannot partake in the AGM, or they cannot share the dividend. They are not eligible to vote in the AGM. Such members are known as nominal members. But department says that if such members are allotted, since they are not having the right for the voting, they should be treated at par as a public. So such loans provided to such members, this deduction cannot be eligible. This is the version of the department, but this decision clearly states that even as per the respective state act, these nominal members are admitted as a member, then they can be treated at par with regular members. So loan provided to nominal or associated members are also to be treated as regular members and are also eligible for deduction under section 80P2A1. So a major issue has covered in this decision. Then coming to interest on investment, there are a lot of statutory provisions are there. So society should invest in statutory reserve as well as they have to invest in voluntary reserve in order to preserve their funding. So income from investment from maintaining statutory reserve or income from investment from maintaining voluntary reserve are there. So department says that since this interest on investment, even if it is statutory as well as voluntary investment, they are not they shall not be take the character of income from banking activity. So they cannot be treated as income from business or profession. They should be treated as an income from other sources only. If it is treated as income from other sources, then if it is from other banks and not from any other societies, then this deduction under section 80P2A1 is not available to such interest income. If it is from societies, we can claim deduction under section 80P2D. But if it is not from any other society, if it is not, it is from any other banks or treasury, etc., or any other institution, then such societies, this interest shall be treated as income from other sources, and it shall be paid applicable taxes in these cases. This is the contention of the department. They are relying on the decision of Thotkar Cooperative Sales Society Limited. In this case, it is against the assessee. This Thotkar Cooperative Sales Society is a consumer cooperative society. So investment are from the sale proceeds received from the various clients of the society. In the case of Thotkar Cooperative Sales Society Limited, deposited surplus fund where sale proceeds of agricultural produce belong to the members and temporarily retained by the society. The interest received by the assessee from such deposits or securities was classified as income from other sources and taxable under section 56 of the Income Tax Act. This is what Thotkar Cooperative Sales Society decision speaks about. Department taking the this aspect from this decision, department has come out with lot of orders that all the banks, all the societies interest should be treated as income from other sources and should be taxed. But here this is a consumer cooperative society. In most of the cases, the investment are made by cooperative credit society. They are dealing with financial instruments. They are dealing with cash. They are accepting deposit. They are issuing loans. So they are dealing with financial instruments. In Karnataka State Cooperative Society Cooperative Bank Limited case, Supreme Court held that since these are dealing with the financial instrument, and the income received from this in this investment are should be treated at par with business income alone. It is as part of a business activity, so such interest should be eligible for deduction under section 80P2A1. So they are differentiated the decision of Thotkar Cooperative Society Limited. In Karnataka Cooperative Apex Bank 251 ITR 194, and in CIT basis Bangalore District Cooperative Bank Limited, Mahesana District Central Cooperative Bank Limited, and Gujarat State Cooperative Bank Limited basis CIT, it was held that the interest income earned from investment of statutory as well as voluntary investment are eligible for deduction under section 80P2A1. In the case of Bihar State Cooperative Bank Limited versus CAT, the claim for deduction under Section 80P2A1 relates to investment made in government securities or with banks and cooperative societies, which are easily realizable, and such investment have been made in the ordinary course of business of banking carried on by these cooperative societies. It is observed that it is a normal mode of carrying on banking business to invest monies in such manner, and they are readily available, and that is just as much part of conducting bank's business as receiving deposit or lending monies. So such interest shall be treated as part of banking business. In CAT versus Ramanathapuram District Cooperative Central Bank, in this case, the Honorable Supreme Court has held that the interest on securities, subsidies from government, and dividend received by the associate cooperative society carrying on banking business were the business income of the associate, and the associate was entitled to deduction under Section 80P2A1 of the Act in respect thereof. And in Navan Shah Central Cooperative Bank Limited case, the Apex Court held that the investment made by a banking concern are part of business of banking. And in the case of Ahmedabad District Cooperative Bank Limited, squarely covers the issue in as much as it was held therein that investment in the securities which are easily realizable are part of stock in trade, and therefore eligible for deduction under Section 80P2A1 of the Act. And in Tirupati Campus PH2 Cooperative Housing Society Madhyadit Pune IT80 decision, interest income and from investment in banks is eligible under Section 80P2D as well. Based on this decision, there are a lot of decisions has come out by the Cochin Tribunal during 2020 and 1920 and this year. That's Anandapuram Service Cooperative Society, Muttoli Service Cooperative Bank, Mundakayam. There are a lot of decisions. Erimeri Service Cooperative Bank decision, Kirtadiyu Service Cooperative Bank decision, in which they have treated this income interest from investment with other banks or other institution. They are eligible for deduction under Section 80P2A1 itself. So this matter, in the case of credit cooperative societies, interest may be investment with banks and other institutions, may be treated as part of banking activity, and the deduction is eligible under Section 80P2A1 itself. We need not go for 80P2D. If we claim it under 80P2D, then we have to show it as an income from other sources and claim it under 80P2D. But in the case of credit cooperative societies, this can be claimed under 80P2A1 itself. If it is from other society, in the case of other societies, if it is not a credit cooperative society, then such interest income from other banks, which that Totker decision will be applicable, and in that case, cooperative societies other than credit cooperative societies, such interest is taxable under income from other sources. For any other cooperative societies, interest or dividend received from any other cooperative societies are deductible under Section 80P2D. That in the case of a housing cooperative society, they are receiving interest from any other cooperative society, they can claim it under 80P2D, but they cannot claim it under 80P2A1. These are the major decisions with regard to interest on investment. Then another important aspect, the alternate reason for disallowance of ATP in the recent assessment orders are, since the society is dealing with non-members or nominal or associate members, mutuality is missing, and hence ATP doesn't apply. But by the Mavilai decision, the Supreme Court held that even the nominal or associate member, if they are treated as if they are included in the respective state act, then they can be treated as at par with the normal members, and mutuality will not be missing in that case. So this matter is almost closed. Various court decisions are there to substantiate that normal or associate members are also members, and hence it cannot be said that the society is dealing with public. thus eligible for deduction under section 80P. As per the recent Supreme Court decision in the Mavilai Service Cooperative Bank Limited, this aspect was clearly decided. Nominal members are also to be treated as members. Thus, the question of mutuality doesn't arise in such cases. There are a lot of decision in the case in Tamil Nadu High Court also, in Ammapet Primary Agricultural Cooperative Bank Limited, Madras High Court, Kombanai Pudur Women's Milk Producers Cooperative Society, that associate or nominal members are also to be treated as normal members itself. But if the respective state tax doesn't have any provision to include this associate or nominal member, then there will be a problem. So this should be keep in mind. Then with regard to MDS or monthly deposit scheme commission, conducting chit fund amounts to providing credit facility, its amount to providing credit facility is decided in the case of CAT versus Part-Time Cooperative Bank Limited. So income from such activity is also to be treated as at par with banking activity, and so 80P to A1 deduction is very much available to such cases. Then coming to income of cooperative housing society, this concept of mutuality is very much important, because all the contributors to the common fund must be entitled to participate in the surplus fund, and all the participators to the surplus fund must be the contributors to the common fund. There should be a complete identity between the contributors and participators. So in general, there was a perception that since the cooperative society income in the case of a housing cooperative society is exempted, they need not file income tax return. But it is not correct, because they are having a lot of other income also, so they should file return. So a contribution from members of housing cooperative society, normally they are the most commonly credited accounts in the profit and loss account of cooperative housing societies are maintenance charges, municipal taxes, electricity, lift maintenance, water charges, etc. Since these amounts are collected from members, they are not exempted from, they are outside the purview of taxation on the concept of mutuality. Then interest charged on members. If it is charged from the members on mutuality, it is exempt. If it is charged from other cooperative societies, it is eligible for deduction under section 80P2D. And if it is from other banks other than cooperative societies, then it is taxable. Then dividend income, similar from Indian companies up to financial year 1920, it is exempt under section 1034. From 2021, it is taxable. If the dividend is received from any other cooperative societies, then deduction can be claimed under section 80P2D. Then rental income from advertisement hoarding, it is taxable as business income or other income. Expenses, if any, on earning such income can be claimed on proportionate basis. Then rent from mobile or cable towers, taxable under house property income. Rental from use of open spaces, terrace, from if the rental is received from the members on mutuality principle, it is exempted. If it is from non-members, it is taxable under house property. Then non-occupancy charges. Though non-occupancy charges are being collected from the members in their periodic bills, the income tax department viewpoint has been that this amount is received from a member who has not been staying in the premises of the society. Therefore, though he is a contributor, he is not enjoying the amenities of the society, is thus not a participator. Considering the same, the mutuality concept is not satisfied, and therefore this income is chargeable to tax. This is a debatable matter, because this viewpoint is debatable and can always be argued in society's favor, as in some of the court's cases, the ruling given is that while comparing the contributors and participate in concept of mutuality, they should be compared as a class and not isolated or individual contributors. So considering this as a class, these non-occupancy charges can also be treated as coming under mutuality. This is a debatable matter, can be taken up. Then parking fee charges from members, it is exempt. From non-members, taxable. Then transfer fee, if it is from an outgoing member, then up to limit allowed by law, that is up to rupees 25,000 per flat, it is not taxable. Or if it is transfer fee on premium received from any incoming member, it is taxable. Then coming to tax rate, since the time is very less, I am just running through. As per the normal provision, the tax rate of cooperative societies are, if the total income does not exceed rupees 10,000, 10%. If it is exceed 10,000 but does not exceed 20,000, 20%, and exceed 20,000, 30%. So effectively, the tax rate is more or less 30% in the case of a cooperative society. And surcharge if the income exceeds 1 crore, 12%, and health and education says 4% as usual. And in the corporate with effect from 2020, 21, 22, 115 BAD was introduced, and as per this, there is a reduced tax rate prescribed for cooperative societies. Resident cooperative societies under section 115 BAD, tax rate is 22%, health and education says 4%, surcharge 10%. And this option should be exercised by the societies in form number 10 IF. And there are a lot of conditions for availing this. No deduction under section 10 AA or 32(1) 2A, 32AD, 33AB, 35 2 AA, subclause 2, 2A, 3, 35AD, 35 CCC. This cannot be claimed. Then no deduction under chapter 6A other than 80 JJ AA. This 80 JJ AA means in the case of a salary or paid to new employees, additional employees. In other cases, we cannot claim. So this deduction under section 80P cannot be claimed if we are opting under 115 BAD. We cannot set off any carry forward loss. We cannot avail additional depreciation also. Then with regard to audit and return filing, it is mandatory to file return within the due date. Then only we can claim deduction under section 80P. So from 1/4/2018, by the amendment made under section 80AC, if the society filed the return of income as prescribed under section 139(1), then only they can claim deduction under section 80P 2A1 or 2, any other section. Previously, they can, if they file the return, they can claim. Even belated return also, they can claim deduction under section 80P. But from assessment year 18-19 onwards, if they have filed the return within the due date only, they can claim deduction. So filing of the return within the due date is very much important. Tax audit to be conducted if applicable. Then since these societies are auditable under other act, that other respective state tax or central act, the report should be in form number 3CA, and it is not. If it is not auditable under any other act, then it should be under 3CB. Then due date is second due date, that normally 30th September, because these societies are auditable under State Cooperative Societies Act. So second due date is applicable. Then issues in return filing, we should attach the balance sheet in the case of a online uploading of a tax audit report. And if there is a trading activity, we should segregate the income from trading activity as well as banking activity. Then only we can claim their respective deductions. Then audit and return filing. Normal, if there is any disallowance under section 40A1, it should be disallowed. Donation disallowance, depreciation allowance as per IT Act can be claimed. Depreciation loss, if any, can be adjusted against future income, even if in case of delayed filing. Then 40A3 is still applicable to all cooperative societies as usual. 269SS, 269T and 269ST is also applicable. I am not going in detail to these provisions because we are all familiar with this. So all these provisions are applicable to cooperative societies. This 20,000 acceptance of deposit, this is applicable. Repayment, ST is also applicable up to 2 lakh limit. Then compliance of TDS provision. Till 31/5/2015, interest to members of cooperative societies, including cooperative bank, TDS was not required if it is paid to members. from 1/6/2015 to such income credited or paid by a cooperative society other than a cooperative bank to a member or any other cooperative society. There comes an amendment from 1/6/2015. They have excluded the cooperative bank from this provision. So the interest paid to any member of a cooperative bank, this normal TDS provision under section 194A will be applicable. If it is a member of a cooperative society, this benefit is still available to such societies. So TDS on interest is required for any person including members in the case of a cooperative bank. Cooperative society member deposit is still outside the purview of TDS. All other provision of TDS is applicable to cooperative societies as well. From 1/4/2020, there was an amendment. If the turnover of the society during the previous financial year relevant to the financial year in which the interest payment is affected, if the turnover of the society is more than 50 crore, then interest paid to members exceeding the limit prescribed TDS is applicable. If the society is having turnover of 50 crore, then this beneficial clause cannot be come in rescue of the such societies. They should deduct TDS even if it is paid to members. So this should be keep in mind. And 194N cash withdrawal TDS, it is still applicable because it is exempted for banking only. Then exemption from TDS as per circular 9 of 2002 dated 11/9/2002, exemption under 139A(3)(5) is available only to such members who have joined in application for the registration of cooperative society, and those who are admitted to the membership after registration in accordance with the bylaws and rules, and if they can participate in voting is entitled to receive profit. As per this circular, only this person, this benefit of members is applicable. So if it is not satisfying this condition, then in the case of such member, TDS is applicable. But there is a court decision in Jalgaon District Central Cooperative Bank. It was decided that circular cannot override the provision of the Act, because the Act specifically given an exemption to such kind of members. And by way of a circular, restricting that exemption is not correct. So hence the circular number 9 of 2002 is caused and set aside as per this decision, Jalgaon District Central Cooperative Bank Limited case. So this should be also keep in mind while TDS deduction. These are the major areas to be covered. I think I have quickly covered the major part of the taxation of cooperative societies. With this, I thank you all for your patient listening. I think let us move on to the question and answer session. Okay, thank you all.
Thank you very much, sir. You have done a great job in preparing all the slides. PPT is so good.
We'll take 3 to 5 questions at the.
Yeah, let us read the question. Any amount disallowed under 40A3 to 69SS are allowed under ATP. Yes, it is very much allowed, because even if but 269SS is a different matter. It is a penalty provision. If it is disallowance under 40A3, then still the balance total income is still eligible for deduction under section ATP 2A1. But 269SS, I think it will not be like that. It is a penal provision, so it will not eligible under section ATP. So this is regarding interest earned on deposit by a society from other sources. Nationalized bank or cooperative banks is exempted if the deposit is kept for a short time for less than 11 months. There are several case laws, particularly Tomkar Merchant Cooperative Society, Credit Society. Since there is this is regarding interest earned on deposit by a society from other source. If it is a cooperative credit society, they can claim this interest as deduction under section 80P2A1 because they can be treated at par with banking activity as well. If it is not credit society, I think we cannot take that benefit. If it is a normal other consumer cooperative society, then that Thotkar case will come into place, and this interest will be taxable. If it is from cooperative societies, we can claim deduction under section 80P2D. Do we need to file return within first due date to claim deduction under section 80P2, or we can file within extended due date? Yeah, if it is extended means normally society, if it is auditable under any state act, then any state act or other central act, then our second due date, that is 30th September, will be the due date for filing the return. And if it is extended, then we can file within the extended due date. The first due date means July due date for other than tax audit cases. Then second due date is September. This is applicable to such cases. And if it is extended, then 139 one due date is extended. We can file within that due date and avail the benefit of 80P2. Many credit societies are accepting deposit from non-members, but loans are given to members only. Deduction under section 80P2A1 is available. Yes, in this case, in the Mavilai decision, it is specifically mentioned that the loans are provided to members. It doesn't speaks about accepting of a deposit. If loans are providing, because the exemption is also available only in respect of income from providing credit facility to its members. So there in the section itself, it is saying that it is with regard to providing credit facility. It is not talking about anything about deposits. So I think even if they are accepting deposit from non-members, in my opinion, they can avail the benefit if they are providing loan to members only. State Cooperative Bank is essentially registered as a cooperative society. Interest on deposit received by a PAX should be eligible under section 80P2D. The department is using the Supreme Court decision of Thotkar to deny deduction. Is there a way out? There is a one decision, Outdoor Service Cooperative Bank decision. In that, there was a reference that the State Cooperative Bank, Thrissur district cooperative banks, they are all registered as a cooperative society as well. So the benefit of 80P2D will be available to such society, but it is a disputable matter. You can take it up before higher authorities. That issue, that Outdoor Service Cooperative Bank decision may come to your rescue. If a society carries on activity of processing and make the agricultural products fit for marketing, which are purchased from members, whether eligible under 80, I think there is specific exemption under 80P2A1 itself. Here 80P2A, not one, yeah, 80P2A3 itself, there is specific exemption for such kind of activity. They can 100% eligible for exemption. Primary cooperative society carrying on advancing loan to members, accepting fixed deposit from members, apart from other activities such as sale of agricultural seeds and implements at nominal rate, whether eligible to deduction under section 80P. Yes, the income from providing credit facility to its members is eligible for 80P2A1. And with regard to other activities such as sale of agricultural seed and implements, if they are they are to their own members for agricultural purposes, they can claim. Otherwise, if it is for public also, then that part will be taxable. That they can claim deduction under section 50, deduction under section 80P2C up to rupees 50,000 in this case. During the time of demonetization, most of the societies were accepted the old currency, and AIF passed the order under section 68 and 69 by adding okay, what is that? Yeah, by adding the collected amount. What will be fate in appeal? Please explain any recent case laws in favor of the society. I think such decision has not been finalized yet. Any such decision has been come out yet. But this is a debatable matter. 68 and 69 addition, if it is made, then it will not come under ATP. It will be under income from other sources. Then I am afraid that this will be taxable. That is an issue. Cooperative society eligible for deduction under section ATP is liable to tax audit if the turnover exceed the limit as if the turnover exceed the prescribed limit, it is liable for tax audit under section 44AB. You have to file form 3CA. Can you please explain latest position relating to applicability of 194A? I think I have in detail discussed about this 194A. It is very much explained in the slide also. I think SIRC will provide the presentation to members. So if any confusion is there, you can very well contact me. I can clarify. Okay. For housing societies, interest income received from its federation and cooperative banks to be shown under other sources and claim deduction under section 80P2D, or show as business income and claim deduction under section 80. Please explain. In the case of a housing cooperative society, the interest received from cooperative bank will be taxable. Only deduction available to such is interest from any cooperative societies. They can claim deduction under 80P2D. Other than cooperative societies, they can they are taxable. But even you can still come up with an argument that these cooperative banks are still cooperative. We have put some argument before the authority, but it has not been finalized because these cooperative banks are primarily cooperative societies. They are registered as a cooperative societies as such, and thus ATP2 deduction should be available to such societies. That argument we have put forward, but its finality has not reached. We can debate this matter. The monthly maintenance charges received from owners or by resident. Monthly maintenance charges received from owners by resident or homeowners association is exempt from tax on mutuality concept. This is as per section of income tax. No, they are in section 10. No, this is not taxable at all. It is not coming in any exemption clause or like that. You need not show this amount in the return of income. It is outside the purview of taxation. So this mutuality is outside the purview of taxation. So there is no specific section associated with this. In the case of a PAC, in 40A3 and 269S is applicable because loans given received in cash to its members, and if the addition is eligible. I have this question previously came up. We have discussed it. What is ITR form to be used by cooperative urban bank? Usual forms ITR 5 itself, ITR 5. What are the tax rates that are applicable to cooperative urban banks? For cooperative societies, these specific tax rates are there. Urban bank, cooperative urban bank, I have to check whether that rate is applicable or in this. I will just go through that. The special rate is applicable only to cooperative societies. It is not mentioned any cooperative bank. So urban cooperative banks will be coming under usual taxation. All cooperative societies are subject to audit under Cooperative Societies Act. To claim ATP, we have to file return within the due date. Otherwise, the deduction under section ATP will not be available under section 80. Okay. However, the audit under Cooperative Act gets delayed, thereby delaying filing return. How can we tackle this issue? Many societies service the notice and demand. Okay, this is a practical issue because there are a lot of cases coming because of the delay in finalizing the department audit. But in these cases, what we are doing is that we will collect a tentative balance sheet from the registrar, and based on that, we will file the return and tax audit. And later on, if they get a final audited balance sheet or audit report, we will revise the return, and in the remark column, we will say that the figures has been changed due to revised audit report by the department auditor. So by that way, we are tackling this issue now, but this is not a solution to that. this is a serious matter as far as filing of return is concerned. Okay, I think the questions have completed.
Yes, questions are over.
Thank you.
Thank you.
All for the
Great job, and you have done justice in 1 hour. I don't know whether you fall a little short of time, but then definitely you have done justice to the subject, and thank you for your passion and sacrifice for the alma mater CA Institute by taking out your time and sharing your knowledge. And thank you all the members for participation in big numbers. This is so useful, and you can definitely shoot up your questions directly to the speaker through his mail, and definitely you will be able to find out solutions for your problems. So 3 marathon sessions in 3 hours and power-packed presentations for all the 3. I congratulate each speaker and also thank them each for their contribution. Thank you very much, sir, once again. And thank you all the delegates for your participation, and also I thank the chairman and SIRC office for this program, and also Shelva for the technical support. Thank you all. Good night. Stay safe, stay healthy. Thank you very much. Good night.